The world is going through profound changes. And this creates a challenging environment for central banks as we work to bring inflation back to our targets. Russia's unjustified war against Ukraine, rapid change in energy markets, and a fragmenting global economy have far-reaching implications for policymakers. We as central bankers must do our part to ensure price stability, now more than ever. And at the ECB Forum, from the 26th to the 28th of June, we will discuss how we can and will measure up to this task. Please join us.
Good morning and welcome to the 10th ECB Forum on Central Banking here in Sintra. We're looking forward to very rich discussions during the next 2 days. But before I give the floor to the speakers, I would just like to remind you of our media policy. So all sessions here in the panel, during the panels, the discussions, the speeches are live streamed and therefore on the record. All sessions and conversations and conversations on the sidelines of the forum, for example, over coffee, during the meals, or at informal gatherings are considered to be off the record, strictly off the record. The same goes for any other conversations that happen within the conference area here. I would also like to ask you, please, not to take photographs or video recordings inside the conference area and also in the common spaces at the hotel, except for those areas that are designated for broadcasting. And then lastly, I would also like to ask you not to post any social media on anything that is said other than the official comments here. And with that now, I would like to give the floor to Claire, who is our conference moderator. Claire, the floor is yours.
Hello and thank you for joining us here in Sintra and online. My name is Claire Jones and I shall be your moderator. Europe has avoided the sharp downturn that many feared this winter, but during 2023, new sources of uncertainty have emerged. Despite a fall in headline inflation, price pressures remain far too high. Several central banks, including the ECB, have raised rates in response and remain in tightening mode, despite borrowing costs now entering restrictive territory. This is the background to the discussions that will feature in this year's ECB Forum on Central Banking, when we'll be looking at how the world will adapt to more volatile inflation. We'll begin with one of the programme highlights, an introductory speech from President of the European Central Bank, Christine Lagarde. Madame Lagarde, the floor is yours.
Thank you very much, Claire, and thank you to all of you for being here in Sintra and those of you joining us online as well. You're missing the wind and a beautiful, beautiful location, I tell you. Inflation in the euro area is too high and is set to remain so for too long. But the nature of the inflation challenge we are facing in the euro area is changing. We are seeing a decline in the inflation rate, headline predominantly, as the shocks that originally drove up inflation wane and our monetary policy actions are transmitted to the economy.
But the pass-through of those shocks is still ongoing, making the decline in inflation slower and the inflation process more persistent. This persistence is caused by the fact that inflation is working its way through the economy in phases, as different economic agents try to pass the cost onto each other. Monetary policymakers need to address this dynamic decisively to ensure that it does not lead to self-fulfilling spiral fed by the de-anchoring of inflation expectations. So the key question we face today is, how can we break that persistence? In the ECB's Governing Council, many members of whom are here in this room, we have been clear that two elements of our policy stance will be key. And I will quote elements of our monetary policy statement. We will have to bring rates to, I quote, sufficiently restrictive, unquote, levels, and keep them, I quote, for as long as necessary. Both elements are affected by uncertainty about the persistence of inflation and about the strength of the transmission of monetary policy to inflation. Setting the right level and length will be critical to our monetary policy as we continue our tightening cycle. So in my remarks today, I will explore why the inflation process has become more persistent and what this implies for our policy stance. Disclaimer, typical of a lawyer, some will say. My intention is not to signal any future decisions, but rather to frame the issues that monetary policy will face in the period ahead. So let's look under the skin of inflation. The euro area economy has faced a series of overlapping inflationary shocks since the end of the pandemic. Since the beginning of 2022, these shocks have both raised the price level by 11% and led to us transferring more than 200 billion euros to the rest of the world in the form of a terms of trade tax. In an environment such as this, the natural reaction of every economic agent is to try to pass on these price increases to other actors in the economy. In the euro area, we can identify two distinct phases. The first phase was led by firms, which reacted to steeply rising input costs by defending their margins and passing on the cost increases to consumers. The intensity of this reaction was unusual. During previous terms of trade shocks in the euro area, firms have tended to absorb rising costs in profit margin as slower growth made consumers less willing to tolerate price hikes. But the special conditions that we experienced last year turned this regularity on its head. The sheer scale of input cost growth made it harder for consumers to judge whether price hikes were caused by higher costs or higher profits, fueling a faster and stronger pass-through. As this was not enough, at the same time, pent-up demand in reopening sectors, excess savings, expansionary policies, and supply restrictions brought on by bottlenecks gave firms more scope to test consumer demand with higher prices. For this reason, unit profits contributed around 2/3 to domestic inflation in 2022, whereas in the previous 20 years, the average contribution had been around 1/3. This, in turn, led to the shocks feeding into inflation much more quickly and more forcefully than in the past. This first phase, however, is now starting to wane. Largely thanks to lower energy prices, year-on-year producer price inflation has already dropped by 42 percentage points from its peak last summer. And while it is taking time to feed through to prices more generally, it is partly being reflected in a broad-based decline in headline inflation and a leveling off in some measures of underlying inflation, especially exclusion-based measures and those that capture the persistent effects of energy on economy-wide prices. At the same time, high inflation has eaten into domestic demand, which contracted by 2% over the last 2 quarters, and the consumption impulse created by excess saving is fading. The early effects of our policy tightening are also becoming visible, especially in sectors like manufacturing and construction that are more sensitive to interest rate changes. So faced with this combination, falling input costs and dwindling demand, we saw unit profit growth slow markedly in most sectors in the first quarter of this year. But the second phase of the inflation process is now starting to become stronger. Workers, who are also consumers, have so far lost out from the inflation shock, seeing large real wage decline, which is triggering a sustained wage catch-up process as they try to recover their losses. This is pushing up other measures of underlying inflation that capture more domestic price pressures, particularly measures of wage-sensitive inflation and domestic inflation. And since wage bargaining in many European countries is multi-annual and inertial, this process will naturally play out over several years. In our latest projections, we expect wages to grow by a further 14%, 1-4, between now and the end of 25, in real terms. While this catch-up has long been factored into our inflation outlook, the effect on inflation from rising wages has recently been amplified by lower productivity growth than we had previously projected, which is leading to higher unit labor cost. Alongside past upward surprises, this is a key reason why we recently revised up our projections for core inflation, even though our expectation for wages remained broadly the same. 2 features of the current business cycle are contributing to this dynamic, and both could linger too. The first is the resilience of employment relative to GDP growth. Some call it the mystery, not all. Typically, most of us would have expected slowing economic growth over the last year to have somewhat reduced employment growth. But for the last 3 quarters in particular, the labor market has been performing better than an Okun laws-based regularity would suggest. That disconnect partly reflects increased labor hoarding by firms in a context of labor shortages, which is visible in the current gap between total hours worked and average hours worked. And this is weighing on productivity growth. And with unemployment expected to fall slightly further over the projection horizon, the motivation for firms to hoard labor may not subside that quickly. The second feature, in addition to hoarding, contributing to weaker aggregate productivity, is the composition of employment growth, which is concentrated in sectors with structurally low productivity growth. Since the pandemic, employment has grown most in construction and the public sector, both of which have seen a decline in productivity, and in services, which has seen only a meager productivity growth. These trends could also persist in some of these sectors over the next few years, given the relative weakness of manufacturing and long-term shift towards employment in services. All of this means that we will face several years of rising nominal wages with unit labor cost pressures exacerbated by subdued productivity growth. And in this setting, monetary policy must achieve 2 goals. First, we must ensure that inflation expectations remain anchored as the wage catch-up process plays out. While we do not currently see a wage price spiral, or a de-anchoring of expectations, the longer inflation remains above target, the greater such risk becomes. That means that we need to bring inflation back to our 2% medium-term target in a timely manner. Second, for this to happen, we need to ensure that firms absorb rising labor costs in margin. If monetary policy is sufficiently restrictive, the economy can achieve disinflation overall, while real wages recover some of their losses. But this hinges on our policy dampening demand for some time so that firms cannot continue to display the pricing behavior that we have seen recently. Sensitivity analysis by ECB staff underlines the risks we would face if firms try to defend their margins instead. For instance, if firms were to regain 25% of the lost profit margins that our projections foresee, inflation in 25 would be substantially higher than the baseline at almost 3%. So faced with a more persistent inflation process, we need a more persistent policy. One that not only produces sufficient tightening today, but also maintains restrictive conditions until we can be confident that this second phase of the inflation process has been resolved. So what does that imply in policy terms? We have not yet seen the full impact of the cumulative rate hikes that we have decided since last July, 400 basis points. But we know that the job is not done yet. Bearing a material change to our expectations for inflation, we will continue to increase rates in July. And as we move further into restrictive territory, we need to pay close attention to two dimensions of our policy. First, our actions on the level of rates, and second, our communication on future decisions and how that is influencing the expected length of time that rates will remain at that level. The Governing Council has provided orientation on both dimensions. It has stated clearly, and I repeat, that future decisions will ensure that the key ECB interest rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target, and will be kept at those levels for as long as necessary. Two sources of uncertainty affect the level, the desired level and length of our interest rate policies. First, since we face uncertainty about the persistence of inflation, the level at which rates peak will be state contingent. And it will depend on how the economy and various forces that I have described evolve over time. And it will have to be continuously reassessed. Under these conditions, it is unlikely that in the near future, the central bank will be able to state with full confidence that the peak rates have indeed been reached. And this is why our policy needs to be decided meeting by meeting and has to remain data dependent. Second, we face uncertainty about the strength of monetary policy transmission. The strength of transmission connects current decisions with expectations of future policy and therefore affects the policy stance. How strong transmissions turn out to be in practice will determine the effect of a given rate hike on inflation, and this will be reflected in the expected policy path. Uncertainty about transmission arises from the fact that the euro area has not been through a sustained phase of rate hikes since the mid-2000s and has never seen rates move so fast, so quickly. And this raises the question of how quickly and forcefully monetary policy will be transmitted to firms via interest-sensitive spending and to households via mortgage payments. For firms, ECB analysis finds that monetary policy shocks are typically transmitted more quickly and forcefully to manufacturing, reflecting a sector's higher interest rate sensitivity, while there is more muted and delayed impact in services. The key question really today is whether the services sector will eventually catch down, not catch up, catch down, which is what we have seen in previous cycles, or whether it will be insulated from the effects of policy tightening for longer than in the past, given the strength of demand and employment in the sector. That's for firms. For households, there is evidence that it will take longer for policy changes to pass through to interest burdens in this tightening cycle, as a higher share of households have now fixed-rate mortgages than in the mid-2000s. At the same time, once mortgages have been repriced, the restrictive effect may be greater. Gross debt-to-income ratios, which emphasize debt servicing capacity, are higher than in the previous tightening cycles, while the share of homeowners with a mortgage has increased. Both sources of uncertainty will only fade away over time. And that is why we have made our future policy decisions conditional on, first, the inflation outlook, second, the dynamics of underlying inflation, and third, the strength of monetary policy transmission. But to ensure that uncertainty does not interfere with our intended policy stance in terms of both level and length, 2 points are clear. First, we need to bring rates into sufficiently restrictive territory to lock in our policy tightening. We need facts on the ground. Second, we need to communicate clearly that we will stay at those levels for as long as necessary. And this will ensure that hiking rates does not elicit expectations of a too rapid policy reversal and will allow the full impact of our past actions to materialize. And all the while, we need to carefully evaluate the strength of policy transmission in order to avoid an error in calibrating policy in either direction. So in conclusion, it will not surprise you if I say that monetary policy currently has only one goal: to return inflation to our 2% medium-term target in a timely manner, and we are committed to reach this goal come what may. As the author Helen Keller wrote, our worst foes are not belligerent circumstances, but wavering spirits. We have made significant progress, but faced with a more persistent inflation process, we cannot and we will not waver. Of course, we wish, but we cannot declare victory yet. Thank you very much.
Ciao, my name is Elena Molacci. I'm 27 years old and I'm Italian. I am a PhD candidate in economics at the European University Institute.
Hello, my name is Alba Petosi. I'm originally from Albania and I'm currently doing a PhD in economics at the University of Cambridge.
Hola, my name is Fernando Cirelli. I am 31 years old and I am from Argentina.
I am interested in fiscal and monetary policies and international macroeconomics.
I study at Brown University and my research interests are in macroeconomics and monetary economics.
I am interested in macroeconomics, with a particular focus on expectations and information frictions.
In my research, I study how retailers respond to household shopping behavior, how this reduces inequality, and how it affects the response of prices to aggregate shocks.
My research explores the dynamics of cross-sectional variables when the cross-section is connected by a network. Think of prices across sectors in an economy linked by supply chains, output across countries tied together by trade or capital flows, or opinions across individuals acquainted to one.
My research explores whether agents' inflation expectations respond to changes in monetary policy frameworks. Particularly, I test whether agents' expectations respond to the introduction of inflation targeting as a monetary policy framework.
My paper is about open banking, which shifts data ownership from the bank to the customer. With that, now consumers can choose who to share their financial data with. In my paper, I look at what characterizes these borrowers who share their data and assess its impact on different loan application outcomes.
I'd like to remind all of our participants, both those of you in the room and those of you joining us online, that you have until 9 a.m. on Wednesday morning, local time, to vote for your favourite Young Economists paper. The traditional wisdom in central banking has held that policymakers should look through volatility in prices caused by shocks emanating from the supply side. However, in situations where surges risk having second-round effects, such wisdom looks unwise. Today's first session will explore under which conditions policymakers should respond to situations such as those in recent years, when supply shocks have combined to produce inflation that has proven both more strong and more persistent than expected. We'll then move straight on to a second session when we'll discuss who pays for inflation and by how much. The first session will be chaired by Fabio Panetta, Executive Board Member at the European Central Bank, the second by his board colleague, Frank Elderson. Just as a reminder, we'd welcome questions both from the audience here in the room and via Zoom. Mr. Panetta, the floor is yours.
Is it my right? Thank you. Thank you, Claire. Good morning, everybody. Welcome to this first session on monetary policy in the face of multiple supply shocks. This topic goes to the heart of the situation that central banks have been facing as of late. In just a few years, we have seen a terrible sequence of shocks. We had a pandemic, severe supply chain disruptions, a war, an energy crisis, and let's hope this is the end of this sequence. Claire just reminded us that central banks would usually want to be patient, as inflation typically falls once a supply shock is absorbed, in order to avoid exacerbating the risks that temporary supply shock morphs into a negative demand shock. But a combination of several supply shocks may create an inflationary shock of such a size and persistence that inflation may risk getting entrenched. For central banks, it is not easy to address such a situation for a number of reasons. The first reason is that monetary policy influences demand, and with a lag. It cannot do much against the initial spike in inflation triggered by a supply shock. Rather, monetary policy initially acts by lowering demand expectations, making it more difficult to assess how much restriction is necessary to bring inflation back to target. The second reason is the difficulty to assess how long it will take for supply shocks to unwind and for this unwinding to reach prices. Similarly, there is uncertainty on the speed and strength of the pass-through of the monetary tightening to the real economy. This increases the risks of policy errors on both sides. So today's session is of great relevance for the current monetary policy debate. We are first going to hear from Silvana Tenreiro, member of the Monetary Policy Committee of the Bank of England. Silvana will have 25 minutes to present a paper co-authored with colleagues from the Bank of England. And she will address the topic of this session with particular emphasis on the role that should or should not be given to inflation expectations. Daniel Gross, Director of the Institute of European Policy Making at Bocconi University, will then have 15 minutes to discuss the paper. There will be subsequently the opportunity for questions and answers. Participants wishing to comment or ask questions could prepare to raise their hands virtually if you are following online. So, Silvana, let me thank you for accepting our invitation and for your very interesting paper. The floor is yours. Thank you.
Good morning, everyone, and thank you for having me. I will talk about monetary policy in the face of supply shocks. And this is joint work with my colleagues at the Bank of England, Niccolò Bandera, Lauren Barnes, Mathieu Chavat, and Lucas von den Berg. The usual disclaimer applies. The paper represents our views and not those of the bank or any of its committees. So in this paper, we address three perennial questions in macroeconomics. First, how should monetary policy respond to a supply shock? Second, how would that response change if supply shocks became more frequent? And third, what role should inflation expectations play in the assessment and calibration of that response? And let me start with a preview of the main takeaways from our analysis and our reading of the literature. First, whether monetary policy should look through, tighten, or loosen in response to a single supply shock depends on the nature and duration of the shock, on the strength of second-round effects, and on the shock's effects on real incomes and demand. Efficiency considerations also add nuance to the response. Second, if a sequence of negative supply shocks keeps inflation above target for a longer period, signs of drifting inflation expectations or stronger backward-looking inertia would call for a tighter policy response. But third, the mapping between measures of expectations and policy is not a straightforward one. Despite their prominence in economic models and policy thinking, our understanding of the formation and the impact of expectations on pricing behavior and activity remains limited. It is a humbling exercise to read in particular the most recent literature on expectations. This suggests caution on pinning policy decisions too strongly on measures of expectations or in using inflation expectations as intermediate targets for policy. The soundest policy, as always, is to focus on returning inflation to target in the medium term. In answering the first question, how should monetary policy respond to a single supply shock? The first observation is that supply shocks come in different shapes and sizes. We focus on a particular shock, a global increase in energy prices, as seen from the perspective of an energy importing economy. The orthodox monetary policy response to a global shock to energy prices is to look through them. For instance, in 2011, UK inflation rose above 5%, largely owing to a sharp increase in global energy prices. The Bank of England's Monetary Policy Committee did not raise interest rates in response, and when the shock faded, inflation returned to the 2% target. The rationale for looking through energy price shocks is that the main effects of monetary policy on the economy come through with a lag. Estimates of the speed of policy transmission vary, but the peaked impact of policy on inflation typically comes sometime beyond the first year following a change in the policy rate. That makes responding to short-lived price-level impacts of energy shocks counterproductive, since they drop out of the annual inflation calculation by the time the policy impact is at its peak. trying to offset the shock with an increase in the policy rate would cause more inflation volatility rather than less, making it more difficult to meet the inflation target in the medium term. So for concreteness, in this chart, we illustrate some stylized paths for inflation in the case of an unexpected increase in global energy prices that raises measured inflation from 2 to 6%. After 12 months, assuming energy prices remain at their new higher level but do not experience another unexpected shock, the energy contribution to headline inflation will disappear, and the headline inflation rate should fall back to target. The inflation path under the looking through scenario is the one illustrated here in the blue line. Now, rather than looking through the shock, the central bank could try to lean against the shock by tightening monetary policy, as illustrated by the various dotted orange lines. However, as said, monetary policy works with a lag, building towards peak effectiveness 12 to 18 months after the intervention. If, for example, the central bank wanted to achieve the inflation target 6 months after the shock, it could quickly and more aggressively tighten monetary policy when the shock hits. But because policy works with a lag, to hit the target at 6 months, the central bank would need to be willing to undershoot the inflation target at 12 months and subsequently bring inflation back to target from below by loosening monetary policy. This would be the dashed orange line path illustrated here. Many other paths are possible, but given the nature of the specific shock, any shortening of the period of above target inflation will necessarily come at the cost of undershooting the inflation target for some period in the medium term, the various dotted orange lines here. For a central bank with a symmetric forward-looking inflation target, it's not obvious that shortening the period of above target inflation at the cost of incurring a period of below target inflation is the optimal thing to do. If, moreover, the central bank has a secondary objective to limit output or employment volatility, it may indeed be a suboptimal path to follow. This conclusion changes when there are important second-round effects. As Olivier Blanchard and Jordi Galli point out in their now classical paper, real rigidities can give rise to inertia or second-round effects. For instance, wages, benefits, or certain prices could be indexed to headline inflation, delaying the return of inflation to target. From the perspective of an energy-importing economy, an increase in global energy prices is an adverse terms of trade shock. Real incomes and real wages fall on impact, but if everyone tries to resist a fall in their real income and firms try to defend their real profits by raising domestically set prices, real resistance can lead to nominal inertia and delay the return of inflation to target. This is akin to a cost-push shock in the simple New Keynesian model. Abstracting from questions of timing and policy lags for a moment, the Phillips curve shifts inward, and the central bank faces a trade-off between stabilizing inflation and stabilizing the welfare-relevant output gap, as illustrated here in this chart. In this chart, we assume the central bank seeks to minimize the sum of inflation deviations from target and output deviations from potential, subject to the aggregate supply constraint of the economy given by the New Keynesian Phillips curve. The resulting monetary policy response, MR here, depends on the relative weight the central bank places on stabilizing output vis-à-vis stabilizing inflation, represented by the parameter lambda in the canonical specification. The central bank here will raise interest rates to reduce inflation, effectively leaning against the inertia that stems from real income resistance. But it will not try to return inflation to target immediately, given the impact on employment or output. This is a different rationale for moderation or caution than the one discussed before. In there, the central bank faces a trade-off between above target inflation in the near term and below target inflation in the medium term. Here, instead, the central bank faces a trade-off between stabilizing inflation and stabilizing output. The bottom line is that in the presence of second-round effects, looking through energy shocks may no longer be optimal. By tightening monetary policy, the central bank can bring inflation back to target more quickly without necessarily pushing inflation below target further out, as illustrated by the dashed orange line in this chart. The policy prescription becomes a bit more nuanced in multi-sector models with downward nominal rigidities when sectors have differential exposure to the energy price shock. In that case, efficiency considerations may call for changes in relative prices, which can be facilitated by somewhat higher aggregate inflation. This is illustrated in this chart. Relative prices of more energy-intensive goods should go up as the supply curve contracts, as shown here in the left-hand side. Substitution will lead to an expansion in non-energy intensive sectors, the dashed line in the right-hand side chart here. With downward nominal rigidities, the relative price adjustment calls for some accommodation of inflation. And this is what Veronica Guerrieri, Michaela Markusen, Lucrezia Reichlin, and I discuss in depth in the Geneva report, building on Veronica's Jackson Hole paper. Here I want to focus on what happens when the real income effects from the adverse terms of trade shock is strong, as formalized in a recent paper by Adrien Auclair and his co-authors. The point they stress is that in a heterogeneous agent model with financial constraints, the real income loss due to an energy shock can lead to a reduction in aggregate demand, which endogenously reduces the persistent inflationary effects of the energy shock. This channel, illustrated by the dotted orange line in the right-hand side chart here, can push inflation below target in the medium term. My colleagues, Jenny Chan and co-authors at the bank, make a similar point in a tractable two-agent New Keynesian model, TANK. This chart shows the impulse responses of consumption, inflation, and the nominal policy rate to an energy price shock in both an open economy representative agent model, RANK, and a two-agent New Keynesian model, TANK. The central bank leans against inflation by raising interest rates, which creates a further reduction in aggregate consumption. But compared to the representative agent baseline, the two-agent model with some constrained households generates a weaker path for both consumption and inflation in response to the energy shock, which requires a looser path for monetary policy to return inflation to target in the medium term. As Chan and co-authors highlight, and in line with Auclair and co-authors, for sufficiently severe financial constraints, the optimal monetary policy response could be an outright loosening of the monetary policy stance. In an economy that exhibits both second-round effects and household or sectoral heterogeneity, the appropriate monetary policy response to an energy price shock is not straightforward quantitatively or even qualitatively. It's not obvious that the central bank can improve on the path for inflation that incorporates both second-round effects from the inflation overshoot and the demand weakness from the terms of trade shock weighing on inflation in the medium term, the solid line, blue line here. Tightening policy helps reduce second-round effects, but risks pushing inflation below target and output below potential in the medium term, the dashed orange line. Loosening policy could help the medium-term outlook for both inflation and output, but would keep inflation higher in the near term and above target for longer, as illustrated in the dotted orange line. And so this is the colorful summary so far. For a single shock, more research facilitating the quantification of all these channels would help address the challenges monetary policy could face with similar shocks in the future. Now, rather than a single shock, economies around the world, including the UK and the euro area, have experienced an extraordinary succession of external shocks over the past 2 years, which have pushed inflation very far above target. The question is, what should monetary policy do when there are multiple inflationary shocks in succession? Some economists have argued that we should expect to experience more and large adverse supply hits in coming decades. But more frequent and systematically adverse supply shocks could be seen as akin to a downward shift in trend growth, with a likely increase in volatility around that trend. Lower potential trend growth will endogenously lead to lower trend demand, and the result of those two forces might not necessarily be inflationary, unless, of course, private consumption and investment cannot foresee the effectively lower trend pattern. In other words, lower potential growth would not require necessarily a tighter policy stance on average unless households, firms, and markets systematically overestimate supply over time, in which case policy would be needed to close that demand-supply imbalance. But what happens when there is a sequence of inflationary shocks in succession without any change in the longer-term patterns? In principle, monetary policy could operate as usual, responding to each shock as if it occurred in isolation. But responding to each shock individually, trading off every time near-term against medium-term inflation and inflation deviations from target with output deviations from potential, could result in a long period of above-target inflation. The models discussed so far all implicitly assume that households' expectations remain well anchored at the target in the medium term. But the question is, can this assumption reasonably be maintained if inflation remains above target for multiple years? And once we depart from the rational benchmark, there is an infinite variety of ways in which people could form expectations and in which those expectations could affect behavior. Indeed, even with a rational setting, as Ivan Berning makes clear in his recent paper, deviations from the standard sticky price Calvo model mean that inflation expectations would typically have a different, in his case, smaller effect on pricing than the nearly one-to-one relation implied by the Calvo setting. Improving our understanding of the role of expectations on the economy is, of course, an important area of research in macroeconomics, but it also calls for humility. As economic researchers, we are on the edge of our area of expertise when it comes to people's expectations, veering into the fields of psychology and neuroscience. The models that deviate from rational expectations have different and interesting implications for the nuances of monetary policy strategy. But the overarching takeaway is that, much like in the case of real wage resistance, the more inflation expectations drift away from target following an inflationary shock, the more monetary policy would need to lean against inertia to return inflation to the target. In the second part of the paper, we turn to the literature on inflation expectations and focus on two sets of questions. First, what factors shape those expectations, and in particular, how does monetary policy affect expectations? And second, how do expectations affect pricing and activity? On the first question, what factors shape expectations, the literature led by Kobion and Gorodnichenko finds that expectations tend to track spot inflation very closely. Inflation expectations also show a very high sensitivity to some volatile components of the basket, energy in the case of firms, and both food and petrol for households. Regarding the role played by monetary policy in shaping those expectations, our analysis and the literature do not point to systematic evidence of a direct impact from innovations or news in interest rates on inflation expectations. And when there is an effect, perhaps contrary to economists' expectations, households and firms more often than not respond that interest rate increases lead to higher price or cost inflation. The evidence instead is more supportive of the standard indirect effect of monetary policy via actual inflation and demand, current or future, which is a mechanism, the demand channel, embedded in most new Keynesian models. Turning to how expectations affect activity and pricing, the literature finds higher inflation expectations may increase or decrease consumption and investment. This reflects a tension between a standard real interest rate channel, which should boost activity, versus a real income effect, which depresses activity. In other words, the impact seems to depend on whether households or firms perceive inflation as driven by positive demand or negative supply factors. On the impact of expectations on pricing, the evidence is also inconclusive, in part because there are challenging identification issues at play. On the theory front, there is new work, but as I mentioned by Ivan Berning, showing that the quantitative impact of expectations on pricing might depend on the modality of price setting, with Calvo price setting giving the maximum impact. Ivan's work also points out that as inflation increases, prices should become more flexible, and hence expectations become less relevant than spot or past inflation in setting prices or wages. So back to the main takeaways. First, the optimal monetary policy response to a single supply shock depends on the nature and duration of the shock, the strength of second-round effects, and the impact of the shock on real incomes and demand, as well as efficiency considerations. The relative strength of these factors determine whether monetary policy should look through, tighten, or loosen, and by how much. Second, a sequence of inflationary supply shocks could result in a long period of above-target inflation if the central bank were to respond to each shock individually, trading off near-term against medium-term inflation and inflation deviations from target with output gap. Drifting inflation expectations or backward-looking inertia in that case would call for a tighter policy response. But third, despite their prominence in economic models and policy thinking, understanding of the formation and economic impact of expectations is still limited, and a large gap remains between standard model assumptions on expectations and their actual patterns of behavior. In particular, empirically, households and firm inflation expectations tend to move with actual inflation and are often highly sensitive to some volatile components of the basket, particularly energy. Identified monetary policy shocks appear to affect actual inflation, but do not seem to have a direct impact on households or firms' inflation expectations over and above their impact on inflation. Recent empirical and theoretical work has challenged existing priors and assumptions on how inflation expectations affect pricing, suggesting a weaker impact of expected inflation on prices than the nearly one-for-one link implied by standard Calvo models. In turn, when inflation is driven by a supply shock, higher inflation expectations can be associated with weaker consumption and investment, while the opposite is true when inflation is viewed as demand-driven. And so overall, first, the high sensitivity of household and firm measures of inflation expectations to volatile components of the basket. Second, their limited reaction to monetary policy over and above the effects of policy on actual inflation. And third, their uncertain effects on the economy call for some caution in using households or firms' measures of inflation expectations as intermediate targets to guide central banks' policy decision. I will pause here, Fabio. And,
Thank you very much, Silvana.
Thank you.
Thank you very much for your very interesting presentation. Before I give the floor to Daniel, let me remind participants to get ready to raise your hands, physical or virtual. Daniel, you have the floor. Thank you for being here.
I wanted to thank the organizers for having me. It's a pleasure and an honor to be here, especially at this juncture when we are facing all these supply shocks and expectations of inflations are doing things which we don't expect them to do. It's actually a theme which was already discussed last year at last year's Sintra conference. But now, of course, we are 1 year on. We are perhaps a bit wiser and have a bit more data also. It's a particular pleasure to comment this paper, which is really well-rounded. It lays out first the theoretical background, and then it provides a really thorough review of the literature of the nexus between oh sorry, I forgot here, the nexus between expectations, monetary policy, and how they work together to have then an impact on the economy. Now, when you have such a well-rounded paper, then the question is, what do you do as a discussant? And I would like to make 3 small contributions by first of all looking at the evidence of some of the factors which Silvana mentioned as being decisive for the impact of supply shocks on the economy, namely real wage rigidity and the importance of financially constrained households. And then asking what shocks actually we're facing today. And there, perhaps, I will try to take at heart the dictum of Kierkegaard, which President Lagarde mentioned yesterday, to live in the future. Try not just look in the past, but also to try to see, okay, what actually should we be expecting? And then finally, perhaps a small compliment to the work which Silvana mentioned only en passant, her own work on the UK, on the nexus between supply shocks and expectations, just doing something similar for the euro area, because my contention would be that actually the euro area and the UK in some respects are very comparable, because they have a similar degree of energy dependency, and actually by chance the degree of openness in terms of goods trade is exactly the same, 21% of GDP. So in that sense at least they're comparable. Of course there's a different size, but not a difference in openness. So the first point is, as Silvana mentioned, from our models and from common sense, you can have a wage price spiral when you have real wage rigidity. I would submit that there's no evidence of real wage rigidity, at least in this case. The question, of course, is how do you measure real wage rigidity? On the left-hand side, I've given you both for the UK, for the US, and for the euro area, the real wages measured by the CPI. Right? And there you can see, I mean, they really have taken it on the chin, workers. Right? One cannot really fault them for not accepting the loss of purchasing power. On the right-hand side, I think that is too often forgotten, I have deflated wages by the GDP deflator, because that is the relevant price index if you look at it from the producer side. And maybe if there had been no movement in that indicator, you could think about wage rigidity. But I would submit to you there has been, by the way, extraordinarily similar development on both sides of the Atlantic. Even GDP deflated wages have fallen. Of course, the question is always where do they go in the future? We can discuss that in a bit. But I would therefore submit no evidence for wage rigidity, but that also means that the increase in energy prices is not really a good excuse or reason for expecting high inflation, core inflation, right? The second point Silvana mentioned also, which is important for gauging the impact of an energy price shock on the economy, is the degree to which we have financially constrained consumers. And we all know that there has been a huge increase in excess savings. Here I've taken just the amount of deposits by households over and above the trend line. For the euro area only, I think for the US the picture is similar. And what's interesting I find is there has been a very large excess savings, 40% of GDP almost, if you look at the difference between the two lines, which has now been almost fully reabsorbed. So we had a period there, again, the past might be different from the future. We had a period when there were few financially constrained households, and now we might be getting back to the quote-unquote more normal situation. Okay, the next point is what actually supply shocks are we facing? And here I would like to go into their development, because I think it is not sufficiently recognized that these shocks have been actually exposed temporarily. all the models, and of course also the things that the charts which Silvana presented, assume a permanent shock for energy, for example. Natural, because we assume that energy prices follow a random walk. Once they go up, best prediction is they stay. But they have gone up and have come down. And now the best prediction should be that they stay down. And therefore, I think this has to be taken into account. But, of course, the economic impact could be very different. Again, that's a point Silvana made, depending on where the terms of trade went. And then we have the supply chain shock, which I would argue that it should have been expected ex ante to be temporary, because it was basically a problem of temporary dislocation in supply chains. Here I have given you the one indicator of the Federal Reserve, I believe, where I draw attention to the scale, because there it's in standard deviation. So you have really something exceptional, 4 standard deviations from the past. But actually my title is wrong there, because supply chain pressures have disappeared, right? In that sense, we are back to the pre-pandemic normal. So that was something temporary, and the echo effect of that should actually be positive for the future. Now, for energy, I would submit that you should look at 2 prices separately. One is oil price, and of course the second one will be natural gas, I come to that. And the oil price here, I've given you both the prices in the US and in the euro area in national currency. Because at times they were very different. You see that in 2008, right, when the dollar price increased a lot, but not the euro price, whereas more recently the difference has been smaller. What I wanted to show with this picture is actually that, of course, you see that price has gone up and down, so the shock has been retraced. The second point is that we are now at a level which we have had in the past several times. We have had these ups and downs in the past, even more extreme to some extent, without inflation. So I think the task for our models and theories is to explain why, with a shock, which is very similar to what we had in the past, we have inflation which is not at all similar to the past. And I think that is very important. Of course, what you also see here is, and that comes about in many discussions, what is the baseline? If you take the deepest or the best point for us at the height of the corona crisis, when oil prices went negative, of course we have had a huge shock. But maybe the central banks then should have seen that there was a temporary positive supply shock, right? And it should have seen through it. Okay, but whatever, that's the past. Right now, I think we are back in a situation which we cannot claim to be exceptional. On the price of natural gas, it might be difficult to see. You see 2 lines, blue and red, which are very closely correlated. And one is the TTF price, the famous Amsterdam spot price. And the other one, which is following closely, is the Japan-Korea marker. Just to indicate that in Asia, basically the spot price moved 1-to-1 with our European price. And then you see a green line down there, which doesn't budge at all. And that's the happy US, where basically there's too much natural gas, which cannot be exported more quickly enough, and therefore prices will stay down. So that is the picture in terms of energy price. I would claim not really totally exceptional, and most of that already back to normal or pre-pandemic. Now, of course, as Silvana also mentioned, from the point of view of a net energy importer, you then have a negative terms of trade impact, which impacts demand, and then impacts the probability that you have excess demand in the non-tradable sector. For the euro area, I've given you the calculations, which I think representatives of the ECB have also made in the past. So the loss of terms of trade was rather substantial. Whereas for the US, let me perhaps go immediately here, it was of a very different size. Here you see the red line, that's the United States. You see actually that the US has had a major improvement in the terms of trade. So you have, if you want, a temporary supply shock, but at the same time a boost to domestic demand, right, which was an additional factor driving inflation, whereas in our case, the green line, you see how much peak to trough, right, the peak of what was temporary was COVID. There was a deterioration, of which I would say most of it has been traced back. The latest data point is Q1. I bet you if you take Q2 2023, we'll be back to the 101 line, which is the average. So I would say in terms of trade, the terms of trade, we have actually come back in Europe. So that brings me to my major issue. How can we explain sticky inflation with shocks which at least exposed were temporary, right? Temporary supply shocks in Silvana's models and others should leave the price level unaffected in the long run. First goes up and then goes down, right? And we talked about that already last year, right? That supply shocks supposedly have a strong immediate impact on the way up, but why not on the way down? Right? How can we explain that when these shocks are over, probably have a price level which is 10 to 12 15 percentage points higher in 2 or 3 years than before the shocks, with energy prices and the global value chains being back to normal? There we must have some asymmetries. And it's not real wage resistance. It's not that nominal wages don't go down because, right, they're very far from being even stable. And then the question is, could expectations be responsible? And that is, of course, where Silvana did a lot of work. I mean, I show you here just to the extent to which this confirms what Silvana said, which is that visible prices, energy prices, this is the HICP energy, drive a lot of the expectations, short-term expectations. I think Ricardo Reis last year already mentioned that if you take the long-term expectations, they're basically uninformative because they're flat. They take their data from the ECB bulletin and say, that's it, what will happen. But if you look at the shorter run variations, here, as I mentioned, we have done a complement to what Silvana did, a similar VAR for the euro area, and I won't go into the details. Some of them are available in the slides which are on the internet, on the website, sorry. But basically, we confirm her findings that inflation expectations follow to a large extent energy price shocks, but also finding that I find interesting that energy price shocks seem to drive ECB policy in the past, right? If you think about the famous 2011 mistake exposed, that was one of the cases of a temporary supply shock. Okay, let me stop here. My contention is that the major supply shocks which we have seen turned out to have been temporary, and we have to explain why they have had such a sticky impact. And I think only if you feel comfortable with that explanation can we then also set policy and set our expectations. Because a priori, the future, the next 12 months, should be a rerun of the last with the opposite sign, right? Energy looks good, no longer supply pressures, and so on. And it is with this conundrum that I would like to leave you, and apologies for the 15 minutes overdraft. Thank you very much.
Thank you, Daniel, for your presentation. And I'm sure that now you are burning to ask questions. So let me remind you that you are supposed to raise your hands. But while we collect questions, I would give the floor to Silvana for a comment, response to Daniel's presentation.
Very good, thank you. Fabio, thank you. Thank you, Daniel, for the comments, very helpful. So I would briefly comment on a couple of things. I think what this underscores is the importance of understanding the whole input supply chain and how the energy shock transmits through the various sectors in the economy and through these input-output linkages, because even core sectors are very dependent on energy, so we cannot, completely separate. And in this, I want to highlight, on the theoretical side, the work that Elisa Rubo has done on highlighting these input-output linkages, and on the more empirical side, the work that Shebnem Kalem-Lioskan and co-authors, and then in the Geneva report, Veronica Guerrieri and co-authors, highlighting how a temporary shock, by the time it permeates through the rest of the economy, can have a slightly longer lasting. But we haven't seen the end of the story. So the question is how quickly inflation will come back, and so that's the open question. It took a year and a half to go up. How long will it take to go down? And I agree with you that there is more to that than just real resistance. Part of that is a natural process. Those prices, those high energy prices last year are still in the inventories of many companies. And then there's an additional question, of course, that is discussed lively in Europe with profit margins and so on. And just to highlight, Europe, the euro area and the UK obviously were exposed to the same shock in a different way than the US. Quantitatively, however, the size of the shock was very different. The cumulative increase in energy prices, retail energy prices in the UK, was 115% at peak. For Europe, for the euro area, that reached peak at 80%, but then unwound very quickly. In the UK, because of the Ofgem mechanism of price setting, it takes a bit longer for that to unwind, and we've seen the first tranche down, but there's still more to go. In the US, again, it's a very different story because it's not a net importer economy, it's a net exporter on the margin, and energy prices went up only by 30%, and again, reversed very quickly. So these are very, very different shocks quantitatively and then qualitatively across the Atlantic. I'll stop there, Fabio, and perhaps we can...
Let me remind you that you should keep your questions within 60 seconds. So I see Volker, then Riccardo, Lucrezia, I saw you, then Lucrezia. And then please ask the floor also from home, don't be shy. Can you please identify yourself?
Yes, Volker Wieland, Goethe University, Frankfurt. Thank you very much. Just, I try to be brief, but I would like to submit a different narrative. All the discussion was about a sequence of energy price shocks. But I think you need to go back to the pandemic, 2020, the policy response, which lasted well into 2022, and then the Ukraine exogenous shock. But if you look at models who combine macro and epidemic modeling, just like Eigenbauer-Bello-Trabant, a new Keynesian model, and you simulate a pandemic, or you study a pandemic, you will find that you can have an 8% of GDP recession with a very mild disinflation impact of 60 basis points. That's because the gap between supply, between potential and GDP is much, much smaller than 8%, about 1%. On top of this, that's what, from that perspective, explains quite well what happened in 2020, namely a very mild disinflationary effect. But then you have a very expansionary policy, monetary policy, fiscal policy, unprecedented, lasting well into 2022, all throughout 2021. So you have high demand side support and an endogenous response as the economy recovers and an endogenous rise in energy prices. So the foundation of inflation was laid, in my view, because of that very strong and lasting support. And as luck has it, inflation was at 5-6% at the end of 2021, 2022. Then on top you get a temporary shock like the Ukraine war. But if that story is right, you have to remove that foundation of agri demand, and you cannot wait just for this to go away by itself.
Maybe we take another question, then you will answer both. Riccardo?
Thank you. Ricardo Reis from the London School of Economics. Sylvain, you concluded, and I think I'm reading it right, our understanding of the formation and economic impact of expectation remains limited, suggests caution on policy decisions to rely strongly on expectations measures. Going back just an hour ago to Madame Lagarde's speech, she did mention expectations in one paragraph. She also mentioned, and I ask us to replace in that sentence, productivity. Surely our understanding of the formation of productivity and how it evolves quarter to quarter is also very limited, and how it transmits to unit labor costs is very hard. She mentioned profit margins. Boy, there we barely even have a literature where profit margins, markups sometimes go up, sometimes go down. It depends strongly on industry, it depends strongly on sector. And third, wage formation, which continues to be very hard to understand in terms of what we've observed even in the recent past. So when you ask for humility, should I understand that you're asking for humility with regards to all economic indicators? And I think I've covered all. And if I went back yesterday to Gita Gopinath and employment, financial stability, one can also talk about our difficulties in their formation and impact. And therefore, to have a much stronger focus instead on inflation, I guess. Or is there something about expectations that led you to highlight that in terms of your talk? Thank you.
So should I respond?
Yes.
So let me start with Ricardo. I mean, definitely, I guess I agree with you that we should be humble in general, and that's why we have big fun charts when we do our inflation projections, and sometimes the numbers, the point estimates are taken literally, and people don't understand the uncertainty surrounding those estimates. Or get too trapped in the exact point estimates without taking into account the probability distribution and the conditionality of many of these forecasts. So I would agree with you. The reason I focus mostly on expectations is because perhaps this is the most uncertain area, because there is a projection forward by actors that perhaps don't have the tools to, perform those projections, and within the whole setting if you think of profit margins, wage formation, I mean, we're seeing it on the ground. It's not a projection. It's something that we can observe more and more in real time. But I agree with you that when we project those forwards, there is ample scope for uncertainty. Same with productivity, and obviously we have a very active field in economics trying to understand productivity and what drives it. My focus on expectations is because it comes mostly in the context of these discussions. But I would fully agree with you that all these other aspects are hugely important. And on Volcker, I mean, Volcker, of course, I am fully aware of what happened. And aggregate demand, the responses of monetary and fiscal policy during the pandemic were extraordinary. We were in extraordinary times. It was once in a lifetime shock. You might question when the support should have stopped or not, but we haven't seen, certainly in Europe, and this is very different again from the US, we haven't seen an expansion in aggregate demand. In the UK in particular, consumption is not back at the level of 2019 pre-COVID. So we're not talking about an overheated demand. We're talking about a severe supply shock that led to a substantial response by policymakers, and then obviously there's a quantitative debate on the size of that response and when to end it, but that's a separate one. For the US, the situation is very different because in the US, as you know, consumption recovered to pre-COVID levels early in 2021, overtook the pre-COVID trend by the middle of 2021. So we've seen really, a boom following COVID. Very, very different from what happened in Europe. The Euro area is still well below the pre-COVID trend. And as I said, the UK is below the pre-COVID level. So it's a very different picture in the jurisdictions.
I think Silvana did a perfect summary. And I think the key point is, as you mentioned, in the euro area, as in the UK, domestic demand doesn't show signs of overboarding and therefore being a driver of inflation. What I would submit is that maybe the delayed effect of the monetary easing still going on in 2021 should have been felt in 2022 and should now be slowly fading out. That could have been one of the additional elements last year.
I already have a long list. I see nobody asking the floor from Zoom. Am I wrong, or I don't see anything on my screen? But anyway, I have on my list, I've certainly forgotten somebody. Lucrezia, Jordi, Robert, Christine, and Tiff. Then we will see. Okay, Lucrezia.
Thank you. I just wanted to comment on two important points that Daniel made on oil price. I think you made 2 points. We had similar shock in oil, but in energy, but a very different response from the past on inflation. And the second point is it matters whether the energy shock is temporary or permanent. So I'd like to offer some empirical evidence, which is actually in the Geneva report that we co-authored with Silvana, that in the past, in the euro area, I mean, if you shock the economy with an exogenous oil shock and you look at the general equilibrium effect, actually core inflation reacts with a lag, and from the first shock until it returns to the steady state is about 60 months. So I think that is more or less, so we are still in the norm of what we have seen in the past. And the second thing is that the core is a lagging indicator with respect to headline. So this is a feature that maybe is different in the US economy, but is incredibly robust in the euro economy. So I think it's very important to get these facts straight. Thanks.
Jordi, where are you? There, yeah.
Thank you. Just a quick comment on Danielle's discussion. The fact that real wages have declined somewhat in terms of the GDP deflator, which is the relevant measure, as you said, is not a proof, in my opinion, that there are no real wage rigidities. We don't have a counterfactual. We don't know how much real wages should have gone down in the absence of real wage rigidities. And I would claim that the fact that inflation has gone up that much, in particular GDP deflator inflation, is indirect evidence that real wages didn't go down as much as a model with fully flexible wages would have implied.
You want to answer?
I agree with Lucrezia. Yeah, so and it's part of this input-output diffusion of the shock, and that's what we have in the Geneva report and in previous work that Lucrezia has done. And with Jordi, yes, I agree. I guess it was mostly a comment to Daniel, but there has been, certainly we've seen in the UK, some degree of resistance, and the fact that real wages fell somewhat is not proof that those rigidities are not in certain sectors and certain parts of the economy.
Okay, so okay, I have 3 more questions. If you are quick, we can accommodate all 3 and I see other hands, but let's start with Robert, then Christine, then Tiff. Robert. This gentleman here.
Thanks. A very simple question in answer to the question which Daniel posed there. In the US, we had no terms of trade shock, but we had a lot of fiscal expansion. In Europe, we had that with a lot of fiscal expansion, and if we put both together, fiscal expansion and high debt plays a role in inflation dynamics. And we just heard a paper on the BIS last week by Cochrane about it. So what is part of a unifying explanation why we have this inflation?
Can you pass the mic to Christine? Thank you.
Thank you. Kristen Forbes from MIT. So last night at the dinner speech, Gita raised an uncomfortable truth that central bankers needed to think more carefully about how they responded to supply shocks. This paper is an excellent response, very timely, very quick. But it is very, very nice how it lays out clearly what characteristics of the supply shock determine the optimal response. So I think this is a great resource for central bankers now. But with that in mind, I was wondering if you could talk about how your results would change if you extended the model along 2 characteristics of the recent supply shock. First, one characteristic of the recent energy shock is that countries have responded with large policy responses, energy price caps, and targeted subsidies. And that has mitigated the impact of the big price rise on demand and inflation. We'll hear more about that in Pierre-Olivier's excellent paper tomorrow. But if you then take away some of this effect on consumption and inflation, how does that change? What is the optimal monetary policy response? Second extension, the characteristic of this shock is that the supply shocks were very large. So you can get nonlinear effects, which we'll also hear about later. So if you get nonlinear effects on wage bargaining and price setting, how will that affect your implications for the optimal monetary policy response?
Well, Silvana and Danielle, thank you both for excellent presentations. My question, Silvana, is as you've looked at inflation expectations, what do you think the horizon is that matters the most for monetary policy? I mean, as you showed, longer run expectations have been very well anchored. That's been a great source of comfort to central bankers. But on the other hand, short run expectations have moved around a lot. And going back to President Lagarde's opening remarks, when you think of firms setting their prices, wage bargainers setting their wages, if those short-run expectations are more important for that, the situation might be more complicated. And certainly, at least in the Canadian case, if you look at survey expectations of inflation at the short run, they are above our own forecast. So to put it more provocatively, I mean, are we taking a bit of false comfort that longer-run expectations are well anchored?
Last question.
Last year, John Mulbaugh, last year I talked about the inadequacy of central bank models, and the chart that Daniel Gross put up of how excess liquidity has evolved post-pandemic and how it's declined since is really important. Differences in household portfolios between the UK and the Eurozone have a huge implication for differences in monetary policy responses and also how the real economy is going to respond. And as Christine Lagarde pointed out yesterday, the difference, actually this morning, the difference between floating rate and fixed rate mortgages, those structural differences, another really important feature that distinguishes the UK from the Eurozone.
Thank you.
Okay, let me start with that last one. John, yes, excess liquidity played a big role in the forecasting models of the bank, and this was a reason why we had very strong demand in the recovery from the pandemic in the projections. My colleague Ben Broadbent has a nice description of the forecast at the time, given that excess savings, and connects to what Daniel discussed, we were expecting a much faster recovery in demand from the COVID pandemic. But then the war hit, and then what we saw is actually we undershot massively because the war represented a big, or led to a big increase in the price of energy, very adverse in terms of trade shock. So that played an important role early on, and as Daniel mentioned, most of those excess savings are now being absorbed. There was a question of what expectations matter, and this is a crucial question. I think when we think about the anchoring, typically we think about longer-term inflation expectations, and that's the focus, and for that we need to resort to markets, but those markets are not the ones involved in the actual pricing decisions of firms. When we think about what determines pricing decisions by firms, well, what's the relevant horizon for them? Our intuition comes from sticky price models, typically, with an average duration of prices of 1 year, then you would think it's 1 year that matters, and that's, a point that Ivan Berning makes very clear in his recent paper. Short-time expectations, matter more than those long-term expectations. But obviously, as inflation increases, price flexibility increases, and so prices become very flexible. At the extreme, those expectations shouldn't matter much. I mean, you're really setting prices based on spot inflation or past inflation. So this, I think, is an important aspect to work through more and build that connection between academic models and firms' decision and how they switch to these higher levels of flexibility. I think I'm on negative time, but Christine, yeah, great points. I mean, obviously, when we, as you know very well, when we do monetary policy, we consider aggregate demand with all its influences, and fiscal is a huge influence in there. And basically, what I'm talking here is the residual shock left after fiscal policy or energy policy have done their jobs. And this is what's left for monetary policy. Obviously, when you're thinking about an energy price shock, monetary policy is not the best and first best response to that. You need an energy policy that would take care ex ante, of course, of anticipating and then mitigating the impact of those shocks through diversification of supply, diversification of trading partners, inventory policies, et cetera, and then comes, the remedies that you can put in place when a shock hits. And once you sort of account for all those, then comes monetary policy and picks up the pieces left. In this case, I mean, it was full exposure to the shock, but in the future, hopefully, if we can address this in advance in different ways, maybe the shock will be less impactful and less work will be left to monetary policy. I don't know if you want me to continue. So many questions. But I guess that connects to Robert's question on fiscal. So I'll stop there.
Okay, just wanted to emphasize, we are not facing at present the tailwind of a permanent shock, but actually we have had over the last 6 months a positive shock. So we should be living in the future. And if we had non-linear effects in the past on the way up, should there be also non-linear on the way down? So I come back. I think in the face of temporary shocks, we should look at the question of asymmetry, and that is crucial for understanding of where the economy is going.
Thank you very much, Daniel. I think we need now to bring this session to a close. If I had to summarize the main takeaways of this session in one sentence, I think that sentence would be that, unfortunately, there is no shortcut, no intermediate target or single indicator that would allow to simplify decision-making and the calibration of the monetary policy response to multiple supply shocks. And this is, in fact, reflected in the reaction function of the European Central Bank. We have repeatedly emphasized that our monetary policy decisions are determined by our assessment of the medium-term inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of the monetary policy transmission. Please join me in thanking Silvana and Daniel for their contributions, and I will now give the floor to my dear friend Frank Elderson, who will moderate the next session. Thank you very much. Thank you, Silvana. Thanks a lot. Thank you.
Well, many thanks, Fabio, for giving me the floor. And esteemed forum participants, Fabio, you left a very engaged audience, so I think that we are in for a good session. Privileged to chair the second session of this year's forum, which is titled Assessing the Costs of Inflation. For a while, high inflation was considered a remnant of the past, central bankers worried for a long time about inflation that was too low instead of inflation that was too high. How dramatically that picture has changed after the pandemic and the energy crisis, hasn't it? Inflation has been and will continue to be too high for too long, as the President of the ECB reminded us last night. Central banks have responded forcefully to the surge in inflation by moving monetary policy from highly accommodative into restricted territory at an unprecedented pace. Central bankers are very much aware of the disastrous consequences of high inflation, especially to those people that have little income or little wealth to guard against it. We need little more to be reminded of the importance of delivering on our mandate. That being said, the overall macroeconomic welfare implications of inflation shocks are not easy to assess and depend on many factors. The size and persistence of the shock, the way the economy adjusts, the way the burden of an inflation shock is shared. These are all non-trivial considerations for which we need economic modeling and research. In this session, we have a paper by Francesco Lippi, professor of economics at Lewis University, on exactly this topic. Professor Lippi is currently editor-in-chief of the economic journal, the Journal of the Royal Economic Society. He received his PhD from Tinbergen Institute, and I'm glad to be able to say that in Dutch, in Rotterdam in 1997, and he worked in the research department of the Banco d'Italia until 2006. He's a research fellow at the Center for Economic Policy Research and a senior fellow at the Einaudi Institute for Economics and Finance. His research interests lie in the fields of macroeconomics and monetary economics. He has published many papers on the propagation of monetary shocks, technological innovation, and means of payments choices, and monetary and wage-setting institutions. We start this session with Professor Lippi's presentation for about 25 minutes, followed by a 15-minute presentation by our discussant, and I will introduce you in a second here. Next, we will open the floor for questions and discussion. And at that point in time, online participants wishing to comment or ask questions should be prepared to raise their virtual hands. The online participants were not participating in the discussion in the former session, but please be aware that you are allowed to pitch in as well. But first, let's start without any delay with your presentation, Professor Lippi.
All right. Thanks a lot for the invitation. It is a pleasure and an honor to be giving this talk in front of such a distinguished audience. What I'm going to talk about today is joint work with Alberto Cavallo at Harvard Business School and Ken Miyahara, a very bright student of mine at Lewis University. So we're going to do two things in this paper. We analyze with some humility, two very difficult questions. The first question is about the propagation of a large cost shock. So I'm putting myself in the shoes of a firm that, in 2020 and 2021 witnesses these very big increases in the energy prices that have been recorded in Europe, and has a problem, has to set prices, and finds itself with profit margins that are shrunk. So somehow, something has to be done. So the paper is going to have two angles. One, a question about the propagation, how those shocks propagate, and the second one, what are the welfare costs that this big shock brings about? Now, this is going to be particularly narrow. I'm going to develop the analysis using what I would say is today's dominant paradigm in monetary policy analysis, the New Keynesian model. Alternatives might have been followed, perhaps. They'll come up in the discussion. But I'm going to do my analysis within the framework of the New Keynesian paradigm because it is, in my view, by far the dominant paradigm through which monetary policies are studied in central banks. The whole ideas of forward guidance, Phillips curves, they rely on simple models where firms' prices are sticky. They are not where they should be in an ideal frictionless world. And this stickiness creates wedges, what in my notation is going to be a PI, the price of firm I, which is not equal to PI star, the ideal price. These wedges, you know, the bigger they are, the more misallocated resources are. Ideally, we'd like to measure them. Problem is, we don't really observe P star, so we'll have to come up with some tricks. Second, why do we have sticky prices? Well, the assumptions in this model is that resetting prices takes some resources. Firms have to dedicate resources to the price setting activity, and these resources are a bit of a waste, much like the shoe leather cost we had in the old money demand models. So we're going to measure both distortions using a simple model. And as I said, the thought experiment is we'll write down a model for the steady state, for the tranquil decade that preceded the big shocks, the big energy shocks, and then use the model to answer the question, what happens if we hit this economy with a big energy cost shock? And one challenge for us is going to select a model out of the large class of models that can be written down that is satisfactory in terms of fitting key patterns of the data. So let me review quickly what are the key patterns. This one, we can go very fast. Everyone knows on the left panel, you see the big increases of energy prices in Europe. You know, depending on the measure you take, we could say it's something between 100 and 200%, which my rule of thumb is going to be, as I mentioned, I'm going to give a simple model, so I'm kind of putting my reputation at risk here. I'm going to embrace a simple model and take it seriously. And I want to think that firms' marginal costs, of which energy is an input, shoot up by something like 10, 20%. Firms had to do something. So what did they do? This is a picture constructed on granular data provided by Price Stats, the Billion Prices project that Alberto was a pioneer of. So what you see before 2022, this is a picture for the sector of food and beverages. You see that firms in several European countries in the food and beverage were repricing between 2 to 3 times a year. You know, there's some noise, but it's roughly stable. Frequency of price changes was stable. We were living in a rather stable environment. Then the big shock comes, and what you see an explosion of repricing activities between 2 to 3 times. In France, the average number of price changes goes from 2.4 to 5 or 6. And similarly in many other countries. Now, you might think this must be something special with food and beverages, which indeed are somewhat special. Now, this is a graph I took from a monthly report by the Banque de France, where you see this is for all sectors. It's not just food and beverages. And the blue line is the industry. The orange line is the services. Now, this is also witness to the input-output linkages that have been mentioned before. You know, things first happen in industry, they then transfer to services. What you see, once again, is that on the vertical axis you have probabilities. So there was on average 1 price change per year in these industries. And following the shock, it jumps up to like 2 times that or 3 times that. So we want to have a model that will capture this, because it is a big thing in the data that following a big shock, firms are more active. So what I'm going to do, I'm going to write a simple model. This is the only slide that's going to have something like an equation that is scary looking, but it's underlying my sort of reasoning and putting some discipline in what I'm going to do. So what are the essential ingredients of this new Keynesian model we write down? And the details are in the paper that is posted online. Firms, a firm I is trying to control this variable X. It's a gap between the actual prices they have and the ideal price they would like to have. This ideal price P star is pushed around by idiosyncratic shocks in normal times. If you look at what firms do in normal times, let's say the decade before the shock, sometimes they have big price increases, big price decreases. We're going to think of these idiosyncratic shocks that hit firms. That's a sigma. That's a sigma that you see there. But then, in my thought experiment, at some point there will be a big, large shock that hits all the firms. and everyone's marginal cost will go up. That's the energy shock. That's common to everyone. That's why it's an aggregate shock. Now, what do firms do? They solve a complicated problem that I took from Caballero and Engel, but in the end, it boils down to a very simple idea. Firms have to solve a problem. Prices are sticky. What does it mean? That blue and red object there is the cost for the firm in terms of foregone resources, foregone profits of controlling their prices. They have to hire someone, their marketing guys, their statisticians say, okay, tell me what the right price should be, tell me what our competitors are doing. So we're going to parameterize that model in a way that captures aspects from the data. And why are the firms wasting these resources? Because they want to have a small x. They want to keep x as close as possible to a good value. This boils down to something like this. The model produces this V-shaped blue function. It's a function that has a very intuitive explanation. It's telling us what firms, the probability that we observe a price change. How does it work? Well, you see the function has a minimum at 0. At 0, firms are happy with their price. P is close to P star. Now, the more P deviates from P star, the more firm is unhappy and it spends more resources such that a price change will occur. Now, it might seem totally natural to you. Typically, we tend to invest more energies into something that is more important to us. It's basic cost-benefit analysis. Yet, I must mention that the textbook version of the sticky price model we use and that I see in several papers is a model that is totally oblivious of this point and assumes that price resetting occurs with some time-dependent probability. Think of Taylor's 1980s, you reprice every T periods, or maybe the recent Calvo version with some probability you do something. Now, that seems like a very bad description. You don't tell this to a businessman because that's not what they do. They think about things to do. Anyway, let's keep that in mind because we're going to use it as a benchmark. Now, one nice feature of this blue line is that we see it in the data. Several people have tried smart ways to measure P and P star and come up with estimates of probabilities to see a price change. And those V-shaped patterns you see in these three graphs come from different papers, and they provide us with strong evidence that behavior is, as we say, state-dependent, that the probability to observe a price change depends on where the firm is. Now, why does it matter? So ideally, what we would like to measure, remember, each firm has an x. So this f of x is the cross-sectional distribution of the x's. Ideally, I, Francesco, want to know how efficient is the economy. I want to go out there and measure all the x's. I want to learn about f of x. F of x is not really directly observable. So we have to come up with some tricks to measure something like the variance of f of x. Jordi has a very nice paper where he shows that the consumer's welfare is approximated by, up to first order, by the variance of those x's. So how do I measure f of x? Well, I have lambda, I have f. A composition of these two functions gives us something observable, the distribution of the size of the price changes. It's those blue histograms you see there. The red curve you see in the first one on the left is the prediction for the size of price changes in my model. And the rest is just data. So some things are intuitive. There's very little tiny price changes. Well, there's no reason to have a price change when your price is close to the good one. There's both very big positive and very big negative price changes. That's because of the idiosyncratic shocks. So these are data that we calibrate the model with using these are building blocks of the model that we use to calibrate the model using 3 different data sets. The first one is this very granular, very high frequency daily, actually, food and beverages sector that comes from the Billion Prices project. And what we're going to measure standard deviation of the price changes. That's going to be a proxy for the idiosyncratic shocks, the sigma I mentioned before. If you see an economy where the standard deviation is large, it must be that those firms are hit on average by big idiosyncratic shocks. Big positive, big negative. Now, the frequency is a natural measure of how flexible the economy is. If you see an economy where everything happens, repricing is very high, it must mean that maybe the cost of repricing is not so high, and firms are happy to do it. Kurtosis is a measure, I should have mentioned it. When we look at these distributions, I want to get some information on how thick are the tails of the distribution. If I have a distribution with thick tails, it means that I have some agents in this economy whose gaps are really big. Big positive and big negative. And that's going to be like bad news for efficiency because the costs are non-linear. So having some extreme outliers there is going to be costly for our economy. So I take data both from the price stats data, from recent analysis for the euro area in particular. The data that appear in the bottom panel are data that I obtained from Erwan Gauthier, who coordinated the Prisma data project at the ECB, a major project using CPIs. There's a big difference between those data and the one in the first row. The CPI data are obviously more encompassing. Yet, if you eyeball those numbers, they're not incredibly different. The thickness of the tail is roughly close to that of a normal. The frequency for the overall price index is kind of lower. It's one price change per year on average. So what do I do with this data? Well, first, I come up with an idea about, okay, how can I measure? Remember, I want to have some information on the variance of X, that object you see there. Now, that first equation there is something that people in my profession consider a synonym of beauty, because it's an object that allows you to map something unobservable, the variance of X, into something observable. And what's the idea? The idea in the end is very simple. So the first formula, the eta divided by 2 times the variance, comes from Jordi's approximation of the consumer's representative utility. Now, why is the variance proportional to those red objects on the right? I already mentioned a large variance of price changes means that we are looking at an economy in which when we see an agent taking an action, he does something big. So doing something big on average, that's what the variance is telling us, means that on average you're far away from where you want to be. So that's bad news for the welfare. It means variance is high. Now, for a given variance, kurtosis means that you have more agents in those tails, and that's also going to compound to the overall welfare cost. Then the model also allows us to quantify how big are the resources that firms employ in this wasteful price management activity. So when we apply this to the data, and here for simplicity, I'm just using the Prisma data. In the paper we have several countries. What we get is that the misallocation cost, expressed in terms of as a fraction of consumption, the misallocation costs are quite sizable. They amount in the steady state. This is before any shock occurs. I haven't yet told you the interesting part of my story, but it's like 1.5% of GDP. And the price management costs are about 50 basis points. So overall, this simple model, which has many caveats, and I'll be happy to discuss them, is suggesting something like the welfare costs, because of these sticky prices, this is really what is causing these wedges, are not negligible. They're in the order of 2%. So what am I going to do now? I'm going to take my model, which was calibrated on this tranquil period before the shocks, and I'm going to hit it with a shock. What a shock does, you remember this blue distribution, this depicts how the price gaps were distributed before the shock. Now the shock shifts the distribution. Every firm has a little bit smaller gap, and they would like to push it back up. In the picture now you see a small shock. Why small? Well, I shifted just by 2%. But the energy shock I claim was big. Big, I mean this. Small, big. What happens when the shock is big? Notice the dashed gray line in the background. That's reminding us of the state-dependent policy, what firms want to do. Now that you have a lot of firms in the red histogram, there are many firms that are sitting on top of a very high repricing probability. That's a V-shaped gray line. So what do you expect? You're going to see a lot of repricing. You can't get that if your repricing rule is a flat constant. Okay, that's obvious. So here's what we get. Large shocks are different. This has been said many times today, and I'll give you what I think is strong evidence in favor of that. This is a theory experiment in the model, but we saw the data before. So look at the red line. There's a constant, this is again, for the food and beverages, there's a constant repricing at 2.4 price changes per year. Now, if we hit the economy with a small shock, you basically don't see much because the shift is small. And so the Calvo model or this rule of thumb models, they're good for tranquil times. They work in tranquil times. But when a big shock comes, what the model predicts is that you're going to have an explosion of price changes, many more, And that cannot be predicted by that model. Now, we could say, okay, who cares? These are, academic debates. You can fight guys in the back room. But I think it has a policy implication. And let me get to the policy implication. Let's take an economy where the price is going at 2% per year. And then hit it with a shock, a cost shock, that raises by 20% the CPI. 20 is just a random number. That's it. So flexible prices, what you would see, it's an immediate jump, costs go up, markup pricing, prices go up, that's it. Now, what happens if I am an economist and I'm predicting what is going to happen using one of those time-dependent models that forgets to take into account the fact that, firms respond to the state? I'm going to draw a line like this. Little by little, firms are going to adjust. If I'm using a model where half of the firms adjust every year, it will take 2 years until everyone has adjusted, and that's it. Now, but remember, this is a big shock. So the state-dependent model is going to give us a very different behavior. Both models are going to get to P star in the long run. They have to. That's what they're doing. That's not surprising. Eventually every model gets to the higher P star. The question is, how long does it take? Now, the state-dependent model gets there much faster because the shock is big, everyone is rushing to put the house in order, and everything washes out more fast. So why is this interesting? Well, the slopes of the blue and the red line are inflation rates. So if I live in one of these economies and I just look at the inflation rate, remember, these inflation rates compound over the 2 years to the same inflation rate. But in the blue economy, what I will claim is the right one, you will have a lot of front-loading inflation, a lot of price changes everywhere, and then calm. If you're using a time-dependent model, you're going to underestimate the inflation increases initially, and by necessity, you're going to overestimate the speed with which inflation will come down. So I think this has some policy content, in spite of the simplicity of the model. If I was a policymaker, I should keep that in mind because it has a simple implication for the time profile of a big shock. Now, I motivated this paper with the idea that I also wanted to measure what happens to welfare in these models. And as you remember, welfare has two components in this model. One, this chi, the misallocation, how dispersed are the gaps. These are models where essentially you don't like price dispersion. Price dispersion is a symptom of inefficiency, as it often is in our models. So what happens to price dispersion? Well, following the big shock, with the small shocks, those are the red lines, not much. You can forget about thinking of small shocks and asking questions about welfare. They're not important. There are some technical reasons why, but I'll skip them. Essentially, they have to do with the fact that these are even moments, and even moments don't respond to small shocks. But the blue lines are depicting a large shock. So what happens with the large shock? Well, right after the large shock, all firms are just shifted down. Many of them reprice, and they have right now a very high price. So think about the cross-section in this economy. It's an economy where the price distribution fans out, and that's not efficient. And until time goes by and everyone has repriced, you have this pattern for the blue line that misallocation first increases, and it's gradual because it takes time for, as some prices change, some prices are high, some prices are low. That's inefficient. And the right panel is showing you the price management cost. This exceptional repricing activity, by our assumption, is costly to the firms. So firms have to dedicate resources to fixing this problem. So if we want to come up with a number and I compute the present value of this cost is at every point in time. So if I compute the present value relative to consumption, I come out with pretty big numbers. The estimate for the Prisma data, so CPI-wide, of the misallocation cost, this is like a present value, are in the order of a staggering 1.5%. This is an additional cost on top of whatever was the inefficiency in the steady state. And likewise, a similar magnitude is attributed to the cost of the price management activity. These repricing activities by firms are very costly. Now, these numbers, of course, I take them with 2 grains of salt. They depend on my assumptions about elasticities. I'm using an elasticity, a demand elasticity of 6. Demand elasticity is crucial, as it was in the money demand Bailey's calculation, because it's telling us about the Harberger triangles, how big they are. You may notice that the bottom line for the food and beverages data has much smaller costs, and that's because that sector is a much more flexible price sector. It's a sector where repricing occurs more frequently, so the model is telling us for these agents, the price management costs are not so big on average, so everything can occur through more smoothly. Okay, so I guess I can sum up my job. So I focus on 2 questions in this paper. The first one concerns the dynamics, the propagation of the shock. So, you know, last night Gita mentioned Godot. We're all waiting to decide whether or not we'll come back. I think we sort of go one layer down and try to understand how Godot moves about, what transportation he uses, and information on the means of transportation may tell us something about the likelihood that he will come back. And I think our guess is that he will arrive, unlike in the play, because we do see, with our real-time data, we do see that the frequencies are coming down, so the storm seems to be past. I agree with what Daniel said in the previous presentation. In fact, you know, in my stylized presentation, I am studying a once-and-for-all shock where the price of energy goes up and stays there. But of course, in reality, it has come down. And one can easily use the model to do that. It's a bit more complicated, and I do think the model has a mechanism for generating asymmetries. In particular, the distribution of the price changes that firms face when the negative shock arrives is very different from the steady state one. So that might give you, I don't know where Daniel is, but that might give you some mileage to answer that question. But so what we are trying to do is, there is a policy insight that the data show very clearly, and that simple theory suggests large shock travel fast. I think it's wrong to use old Phillips curves, either call them linear or call them Calvo, in those situations, because in those situations the economy behaves very differently from what it does in normal times. Now, the second point of the analysis was an attempt to quantify the welfare cost within the new Keynesian framework. It was surprising to me that the number that came out were kind of big. To me, these are big numbers. I used to work on the old money demand estimates, and there you have to really struggle to get welfare costs of a 10% inflation, of reducing a 10% inflation to zero, in the order of 1%. You really have to push it to think that money is a very broad aggregate. And there are some beautiful papers by Bob Lucas and Stan Fisher trying to take seriously some simple public finance model to answer these questions. Well, somehow it turns out that in this new Keynesian framework, the costs are bigger. I don't know if this speaks about, maybe the framework, we don't believe it, or really these costs are very big. There are many extensions that one could do to improve the analysis. First one, of course, to consider more realistic path for the shocks, adding sources of stickiness and other sources of heterogeneity that may matter, like financial constraint, etc. But let me say once more, to me, I'm all for adding financial frictions, heterogeneity, stickiness here and there. But to me, what a monetary model cannot miss is a firm deciding about what to do with its own prices. I just cannot use a monetary model in important times that assumes that firms are waiting for a lottery or a ferry. To me, that's really, when I was a kid, I used to sail. I wanted a compass on my boat, and it was expensive. I put a fake compass, and the fake compass worked in the port, but it doesn't work if you're sailing, so we shouldn't use a fake compass. Thank you.
Thank you. Thank you very much, Francesco. I was going to compliment you with your wonderful time management, but then I saw that you were 1 minute over time, so I'm not going to do that now. So thanks a lot. And before opening the floor for general comments and questions, I will now move to our discussant. Let me introduce Sharon Kozicki, who will deliver the discussion. Sharon is the Deputy Governor of the Bank of Canada since 2021. She shares responsibility for setting monetary policy and overseeing the bank's activities in the financial system. In an earlier capacity, she led the review of the monetary policy framework for the 2016 renewal of the bank's inflation targeting agreement with the government of Canada. Sharon, we look forward to your discussion, and you have a full 15 minutes.
Well, good morning. I'm pleased to be here with you today and very thankful for the opportunity to discuss this important research by Alberto Cavallo, Francesco Lippi, and Ken Miyahara. Their paper, Inflation and Misallocation in New Keynesian Models, makes two distinct contributions. First, they argue that understanding inflation dynamics requires a model of the price-setting decisions of a large number of firms. The model they build is very successful at capturing the state dependence of the distribution and frequency of price changes. Second, they provide estimates of the welfare costs of inflation, and their contributions give us a deeper understanding of the costs of price setting and how these costs may depend on the level of inflation. However, there's more to welfare costs than the model can explain. And in my comments, I'll talk about some additional factors that are important to understanding the costs and welfare costs of inflation. But first, I'm going to offer some views on the costs to firms of price setting. So observation one, price management activities are always part of doing business. Price management always incurs costs, and these costs are higher when inflation is higher. New Keynesian models have tended to assume that prices are fixed at a fixed frequency or with a fixed probability, and with fixed costs of changing prices. And these fixed costs, of course, only incurred when the prices are actually changed. But ultimately, activities related to price setting will always incur costs even if the prices themselves are not actually being changed. So a 2004 study by Zbaraki, Ritson, Levy, Dutta, and Bergen looked at a large US industrial manufacturer and its customers. It found that businesses face a variety of costs when they set prices. Their physical or menu costs, managerial costs such as information gathering, decision making, and communication, and customer costs such as communicating and negotiating prices. Now, while menu costs are most directly tied to price adjustment, these are not the most significant costs. Managerial costs are more than 6 times as much, and customer costs more than 20. In total, the price adjustment costs comprise 1.22% of a company's revenue, a little more than a fifth of its net margin. Now, that study was looking at an intermediate goods producer, but it does provide concrete evidence that price management activities are part of the ongoing costs of doing business. Macroeconomists should have taken note long ago, and I applaud Cavallo, Lippi, and Miyahara for having done so. I very much like their model and their use of microdata. By allowing firms to choose how much to spend on price management as a model, on price management as part of their profit maximization problem, their model can evaluate how these costs and the price-setting behavior of firms may change with the state of the economy. This also helps us develop a fuller understanding of the mechanism behind the propagation of economic shocks, and their analysis shows considerable state dependence in price-setting decision with higher inflation accompanied by higher costs. Importantly, these higher costs can be thought of as implying lower productivity, which means they will weigh on consumer welfare. And they've illustrated why large shocks are passed through to prices more quickly than smaller ones, and this result is clearly important for monetary policy. Now, before moving it to a discussion of additional factors that are likely relevant in assessing welfare costs of inflation, I would like to make one additional point. Now, in a flexible price environment, the efficient or desired price is actually an artificial construction. Don't get me wrong, it's very meaningful in models, just maybe a little less so in the real world. In New Keynesian models, efficient or fully flexible prices play an important role in how we evaluate the welfare costs of inflation. The efficient price is the optimal price that a firm would choose if there was no price stickiness. But prices can never be totally flexible, and as I've discussed, setting them always incurs costs. As I've been discussing, in the real world, businesses need to allocate resources to optimizing prices, and there are inevitably costs associated with doing this. In a recent Liberty Street Economics article, Bruin de Bruin, Dogra, Heiss, Notek, Meyer, Rich, Schonley, Topa, and Vanderklaw reported survey results about the factors that influenced firms' price setting. Firms reported that the strength of demand was the most important factor, and while labor costs and steady profit margins were also very important, the overall rate of inflation also made the list. Many of these factors could be seen as relevant for determining the efficient or desired price in a flex price environment, not only for determining where to set a price relative to that efficient price. Thus, rather than using so-called efficient prices as the basis for cost analysis and welfare calculations, my recommendation is to compare costs across states. And my interpretation, this is exactly one of the things this paper did. It provided model-based evidence that both the costs of price management activities, model-based evidence that the cost of price management activities are higher when inflation is higher. But there are additional costs to inflation besides those related to price management. So observation number 2, households always spend time or money to plan, budget, and shop. And these costs are also higher when inflation is higher. Businesses' costs of price adjustment are certainly not the only factors to consider when examining welfare costs associated with inflation. In economic models, consumer welfare is a function of the present value of current and future utility of consumption and leisure. And it captures the tendency of consumers to prefer to smooth their consumption over time. So in examining the welfare costs of inflation, what happens to wages and leisure matters as well. So I'm going to talk a little bit about these. So this is a rather busy chart, but all it's trying to show is different trends in price setting. Why? Because in most cases, consumers are taking price as a given, and they're allocating their income to consumption and savings. Their consumption of specific goods and services is going to depend on their own preferences and relative prices. And in general, these relative prices are different than those in New Keynesian models. Over the long term, prices of individual goods and services follow very different trends. And these trends are dictated largely by the underlying productivity trends. Over the short term, some prices can be quite volatile, especially prices of food, fresh food and gasoline. Now, consumers might not like having to deal with these types of price movements, but they do adjust to them by allocating time to budgeting, planning, and shopping. They look for good deals and change their consumption patterns depending on how the prices of various goods are shifting relative to each other. So let me move on. Recognizing that consumers make spending decisions all the time in the face of prices that move around and with diverging trends, ultimately, it seems that to them, it doesn't matter so much whether the prices are high or low relative to the efficient price. It matters whether they can afford what they're used to buying. Thus, while there may be some misallocation associated with price stickiness, it's also likely that wage stickiness is going to be a big issue for consumers, and especially if wages are stickier than prices. Now, Drouant, Fabiani, Kesdi, Lamo, Martins, and Sabatini examined a cross-country survey, this is over Europe, and found that firms tend to adjust wages less frequently in prices. So if we think about firms changing prices every year or less, about 50% of firms. 75% of firms, it's going to be less frequent than a year in terms of changing their wages. So this matters because when we're talking about those implications for welfare, when wages are not rising at the same rate as prices, then you're likely to start seeing more people hitting up against some of their budget constraints. Real wages in the euro area have been declining year over year since 2021. And so more people are likely to be finding themselves to be liquidity constrained. means they're spending all of their money right now on their goods and services. In other words, when an increase in inflation leads to real wage declines, fewer households will have the flexibility to smooth their consumption, and this reduces consumer welfare. Inflation imposes additional costs on consumers. So the costs I'm going to discuss now are, again, on top of the costs that firms were already incurring to set prices. And I'm going to give you a few examples just to try and build some intuition. It doesn't matter so much if you can see the charts in the table. I realize they may be small. So the chart does show survey results for consumers in Germany from earlier this year. Now, across income levels and household sizes, consumers reported they were changing their purchasing behavior due to higher inflation. This includes actions like buying cheaper products, which are often lower quality or embed fewer services. They're using vouchers or coupons, which require time to research and organize. And they're cutting spending on some services, such as subscriptions. So again, people are accustomed to seeing price changes from day to day, week to week, and month to month. And they know they need to spend time looking for the best prices across different retail outlets. But with higher inflation, they face more dispersion across inflation rates of goods and services, and they also increased price volatility and greater uncertainty. So consumers need to spend more time to do this. This comes at their expense of their leisure. Or you can think of this as, if consumers have a productivity function over leisure, it's a negative productivity hit on the production of leisure from hours not in work, right? So if consumers are allocating more time and they have less time for everything else, again, their utility goes down. If they buy fewer goods, their utility goes down. If they work more so they can pay higher prices, their current leisure and utility goes down. And if they save less or borrow more, their future utility could go down. All of these are welfare costs. So now perhaps another way of thinking of these costs is as cognitive costs, as in the recent article by Agarwal and Kimball. They used consumer confidence to measure such cognitive costs, as they called them, and found that between 1980 and 2021, higher inflation is associated with lower consumer confidence. The bottom line is this: just as firms need to allocate time to price management, and consumers need to allocate time, effort, and funds to planning, budgeting, and shopping. Sorry, just as one, the other. These factors are generally not modeled. So they're not usually considered when we're looking at model-based evaluations of the welfare costs of inflation. Finally, observation 3. Financial system participants always have to manage risks. With greater uncertainty when inflation is higher, costs of managing risks are also higher. So, same sort of logic here. We need to be thinking of the cost to inflation to individuals and businesses. We need to consider the financial sector. Now, this is an inflation chart. It's actually inflation rates across CPI components in the euro area. The point of this is to show that from 2019 to 2022, this distribution of inflation rates across components shifted to the right and got wider. So not just higher inflation, but more differences across the inflation rates of the components. And really, I'm just using this chart to show an indication of greater uncertainty that has come with the higher inflation. But frankly, we can look to the session that we just had on the services costs to understand how there has been greater uncertainty in the current period with these larger shocks. So again, more generally, more uncertainty, increased uncertainty impacts the economy. It could be a single household considering a major purchase. It could be a business contemplating a new investment project, or a financial institution that's considering whether it should lend to them. So again, I don't want to spend a lot of time. The logic's similar. Greater uncertainty forces all economic agents to put more resources into risk management. And in addition to managing risks, the possibility of tail events increases. And these issues are particularly relevant for financial institutions. To make this concrete, higher inflation can lead to higher inflation risk premiums and bond yields, resulting in higher borrowing costs for governments, businesses, and households. So let me just conclude. Inflation is costly, but not just because price dispersion may increase. Higher inflation tends to raise price management costs for businesses and reduce productivity and consumer welfare. Higher inflation tends to raise planning, budgeting, and shopping costs for consumers and reduces consumer welfare. And higher inflation tends to increase uncertainty, raising costs of risk management. So, price stability is important because it really is a key ingredient to a prosperous economy. Low and stable inflation strengthens competitiveness forces in an economy and allows households and businesses to plan and invest with confidence that their money will hold its value.
Thank you, Sharon. So before I open the floor, and there is an urge to intervene, I've already noticed, so some people have already asked for the floor, so I'm building on a little list here. And I'm also, again, welcoming any questions from those who cannot join us here physically. But before I do that, Francesco, maybe you want to take the opportunity to respond to Sharon. It's almost a court case here, in a reply. And
Okay, thank you. It's my pleasure. First of all, thanks Sharon for the kind words about the paper. It's a simple model, and I agree with you. There are more wedges that one can think of. Certainly, I hope it's not the way that the paper comes through that we do an estimate of the overall cost of inflation. It's just a niche attempt to zoom in one particular but very prominent view of prices and money and interest rates that we have out there. I agree with you about these other wedges. There are important consumer expense, these additional searches for bargains and the changes in behavior that we have actually, we know a lot about. There's a lot of documentation about how in recessions or after big shocks, the less well-off consumers spend time looking for bargains, etc. They also have associated welfare costs that would be great to understand. And likewise, I think in financial services, I think of an old paper by Ayagari, Brown, and Zwiekstein, probably in JPE, where they studied the cost of inflation as, inflation creates a needs for some social insurance. Everyone is trying to pass the hot potato to another guy, and this is great for financial intermediaries that thrive on providing not such a great service. I mean, society would be better off without this intermediation. In the end, someone has to bear the brunt of the inflation tax, and yeah, that's. I'm all for these models. It's just that for today, I had something else on the menu. But thank you very much. Thank you.
Thanks again. So I'll first give the floor to Governor François Villeroy-de-Galhau. And no need to remind anyone that the questions should not exceed 1.5 minutes.
Thank you very much to Professor Lippi for putting such lights on the relation between firms' behavior and macro inflation. And thank you, by the way, for quoting Banque de France data and Banque de France work. And one of the lessons of the Banque de France graph you showed is that the frequency of price adjustment has decreased very significantly in the latest month, which is encouraging. But this brings me to my question about the symmetry of adjustments. Apparently, in your model, be it the blue or the red curve, price adjustments are symmetric. And we could think that when prices go up, it's easier for firms. When prices have to go down, they are a bit slower. And this is all the debate about margins. So did you test, or could you test in your model, an asymmetric stickiness of prices? And this is a key question for us, forecasting inflation in the present situation. And very probably, if we introduce asymmetric stickiness, the welfare costs are significantly higher.
Thank you very much, François. Maybe we take 2 questions. So I'll go to Ignazio Visco, the Governor of Banco d'Italia, and then to Oscar Arce. But maybe after Ignazio, we answer and then we go on. And maybe a microphone.
Well, thank you very much. Thank you. Well, I'm not going to say anything about the misallocation because we have really to study whether the quantification makes sense. But it seems that from what you have shown us, we may have some conclusions on the statement that inflation is being too high for too long. I'd like to understand what you think about. Basically, you seem to say that the size of the shock implies a higher frequency of responses and a quicker adjustment of prices to the increase in marginal costs, total costs. This produces higher inflation than in normal times, the ones before 2022. That is, in our language, the pass-through of the increase in energy costs is much faster now. The implication might be that had we not taken this into account, we would have been under-predicting the actual increase or stickiness, if you want, in core prices. And secondly, I think Francois hinted to that, what would be the implication for the downwards? Daniel Gross showed us that terms of trade have moved dramatically, upwards and now downwards. So the symmetry of the adjustment might imply that we risk to over-predict the inflation level, core inflation, in the future months if we don't allow for the non-linearity you were mentioning. Final point has to do exactly with this non-linearity. We have been talking very much about profits. Now, my understanding is that profit margins, in this case, more or less over a time period are constant, except now increase more and they will be reduced later. This implies that there is now sufficient profits to absorb the increase in wages that are currently predicted. Thank you.
Thanks a lot. Why don't we take the two questions, or the questions from the two governors, and then we continue. Please.
They're very challenging, so let me take them in order. To the Banque de France governor, yes, first, I agree. We see in the more recent data that those frequencies are coming down quite fast. We also see it in our own data, in the price stats data, that the frequency of repricing is going down very fast, which to me is a very positive signal in terms of inflation expectations. I expect inflation expectation, and here I connect with Ignacio, to go down much faster than we think. Just like this model is suggesting, it went up faster than a simple rule of thumb would have told me. And look, I'm not trying to teach anyone's job. I mean, I want to be very modest. I know these are super difficult things. It's easy to do it within a simple model where everything is understood and make this statement. But my view is that there is an element of reality in noticing that when these large shocks occur, everything happens faster. And this seems to be a natural consequence. So as Ignacio said, the pass-through is going to be faster, so there is a risk to under-predict initially, and then to miss the slowdown that's going to come. That's what the model would suggest. Now, I think both of you also hinted at one question about, yeah, but what happens if then, you know, prices go down? The asymmetry, for instance. Now, again, I haven't done the exercise. You know, this was already like quite a challenge for us doing all these things, but certainly the model can give us some guidance. So my guess is the following. First of all, a little more realistic model would have firms worrying not just about their marginal cost, but also about the price of the competitors. So right now you have a situation where a lot of firms have high prices, some still have to reprice. Firms don't like to have prices too different from their competitors. So that's an element of slowing down. My guess is that eventually, if you remember my picture with the line of P growing, then jumping up, then the ideal price jumps down. I think the actual prices will land on that curve. I think it's unlikely that we see a quick deconstruction of the price increases that we've seen, because price changes are costly. But the model will predict that in the medium run, the prices will return to the regional baseline. And I think I agree with Ignacio. Also profits, you know, in these models where stickiness gives an element of investment to prices. They are high initially, but then you know that eventually they will be low, so your profits margin are going down. So the right measure of profits is not profits now, but it's kind of some average measure. And so I guess that on average, these things will balance out.
Thank you very much. Anything you want to add, Chair?
Just very quickly, I think in terms of thinking of whether there's going to be a symmetry going down, we need to not think about the symmetry in inflation or in price space, but the symmetry of what could have been driving the inflation. So that if there's a symmetry on the downside to what we saw on the upside, then we're more likely to see the symmetry in the inflation outcome. And I raise that because on the upside, we had very strong demand simultaneous with cost shocks and supply disruptions. And in some countries, that means estimates of the Phillips curve have steepened. Well, on the downside, what if we don't get all three of those reversing? What if we only get a fraction of them? Then we're less likely to see the symmetry on the down that we saw on the up. And that's in addition to all of the potential pass-through discussions that we had in the first session.
Thanks a lot. I'm aware of the time, but we started a little bit later. I don't know why. So I think that I can allow for 3 more questions because I have 3 more people on my list. So Oscar Arte is one. The gentleman sitting behind the governor of Austria, Holzmann, but I couldn't see you well. And then we will end with Silvana, who also asked for the floor. So maybe all 3 questions at the same time, and then we wrap up. Oscar.
Yeah, thank you very much, Oscar Arce from the ECB. Thanks for the presentation. I mean, I fully agree with the idea that the state contingency in pricing is absolutely critical at the current juncture. Let me share with you a very recent result produced by the ECB staff. I mean, my colleagues find that, for instance, following a large shock to gas prices, the pass-through on core inflation is significantly faster and larger than if the shock were to be smaller. Yeah? So this matters a lot in the current juncture. But of course, the other important element, as emphasized by Governors Visco and Villeroy, is asymmetric behavior. Now, here my specific question is whether you think that this time may be different in the following sense. I mean, all this evidence that you saw us before 22, before the COVID, correspond to an economic environment in the euro area in which wages did not react almost at all to any kind of shocks. I mean, wages were completely flat over the last decade before the COVID or so. This time, we know is different. Wages are reacting quite strongly, and they are expected to grow persistently at relatively high rates for the coming years, as emphasized this morning by President Lagarde. No? So intuitively, one would tend to think that this strong growth of wages will limit the space of firms, no, to moderate the path of inflation, no? Even if they are going to absorb part of these increases in wages through lower profit margins. No? So my specific question, I guess, fits very well with the previous 2 questions, is whether you think that this time, given this reaction of wages, this symmetric behavior that was detected in previous data is going to hold or not, or we face the risk of finding a more persistent disinflation process than if we were to estimate it just based on past regularities. Thank you.
Yeah, so Harold Uhlig from the University of Chicago. Thank you, Francesco, for the beautiful analysis. Emphasizing state dependence makes a lot of sense. Now, to put it more simply, consider a state-dependent model where firms adjust for sure if the deviation from its ideal price is large enough. And indeed, as you argued, why would they not? In such a world, all firms would adjust after large shocks. The welfare cost of price dispersion then goes to 0 rather than shoots up. So it seems the welfare analysis itself is very dependent on the specific nature of the state dependence. Moreover, in that world, you would get a one-time adjustment to prices and inflation goes back to normal instantly afterwards. To a degree that's true in your analysis as well. The results here are firmly and team transitory. But team transitory lost by a mile to team persistent. It wasn't even close. So clearly you must look elsewhere to understand inflation persistence. I believe your analysis actually enhances the point raised by Volker Wieland before, that it can't have been these temporary shocks to prices, because otherwise your analysis would have led to temporary inflation. It must have been expansive fiscal and monetary policy. It must be that the ECB is still keeping its foot on the accelerator. It's not getting to the brakes just yet. Do you agree?
Thank you very much. Then I have Silvana, and I'm going to be super generous because Isabel has also asked for the floor, and I know she is particularly fast in her questions. So, and then we take them all together and we wrap up. Silvana.
Very nice and elegant model, Francesco. I agree with Harald that state contingency makes a lot of sense. One implicit assumption in your welfare calculation is that the shock affects all firms and sectors in the same way, but we've been exposed to very asymmetric shocks since COVID, so and that deviates from the dictum of any price dispersion is costly. Have you tried to calculate the effect when the shocks affects the cost of different firms differentially? Thanks.
Isabel.
Just very briefly, I mean, you showed these charts showing that the repricing frequency is actually coming down. But now we are entering a phase where input costs are actually going down. So if the repricing frequency goes down, that may actually mean that lower prices are not passed through, I mean, to the consumers. So it could have the opposite effect from the way up.
Thank you, Isabel. I trust my two panelists here to be able to somehow address all these questions in a succinct and intelligent manner.
I can jump in.
You want to go first, please?
Sure. So there's a lot again on thinking about persistence, to think about transitory, and to think about what the ultimate drivers are. And I think we all know that this has been a challenging period, and I don't want to say that there's one set of drivers that have been mentioned that were correct and another set that were incorrect. I think, broadly, we know this has been a very historic period with a lot of different shocks. But in terms of the question on, wouldn't everything adjust immediately, and if it didn't, doesn't that suggest there's something else at play? I think in that world, the thing to think about is when the shocks hit, the persistence is unknown. And the size of the shocks wasn't even necessarily known, because you see something and then you don't know if it's going to go up more, if it's going to stay where it is, if it's going to come down. All of that means that you're not going to necessarily be getting immediate adjustment. You're going to be taking some time to analyze, and that's going to take some time to pass through to prices. So there's always going to be this timing aspect to prices. It's not going to immediate. And once you get that timing and you get the supply chain mechanism, things then gradually work their way through if they're big enough shocks. And that does make it complicated. I do think the downside, though, is going to be a very challenging case. As mentioned, some input costs are falling, but at the same time as wage pressures may be going up. And trying to figure out what may dominate, whether they're going to balance or whether the overall state of demand is sufficiently relevant to change that dynamic, I think is going to be really critical.
Okay, so very quickly, again on the asymmetries, look, I don't have any particular expertise on wage setting, symmetry or asymmetry. That's a bit outside of my area. But as I mentioned before, and this also relates to Isabel's question, my view of what is likely to happen, I understand your point. Of course, frequency is going down, which maybe we would like it to go up again and see a lot of price reductions, which of course manifest themselves through an increase in frequency. I think what's more likely to happen, given the stickiness we observe, is that those prices are just going to have very long durations, and there will be a convergence to the trend without much further ado. Because remember, in this model, I mean, the truth is, I haven't worked out the exercise, but you have so many good economists working close to you that I'm sure this will be like a fun exercise for a central bank, and we'll be honored to interact. But it's kind of a simple exercise. Once you have the model, you can answer that question in the model and see what comes out. And my guess, it's just a guess, I guess an educated one, but is that what's going to happen is a reversal to the trend that was there before the shock, with a period of below average price revision. Now, Silvana, the model, again, it's very simple, so I just have one sector. In fact, I know it's embarrassingly simple, but again, it's very easy to kind of do the analysis. Well, maybe we did it. We did calibrations for food and beverages, then for the whole CPI, then Peter Caradi gave us some supermarket data. So it's not completely true what I'm telling you. In the paper, there are estimates for different vendors, but it's very easy to extend and to improve the analysis. Now, finally, Harald, I totally agree with you. I mean, one beauty of the model is that, you see everything. So if you hit it with a huge shock, everyone will change prices, so you can get price flexibility. Now, the size of this huge shock in the model is really huge, in spite of how large they are. So it's a quantitative question, whether or not dispersion goes up or not. What you're conjecturing, in theory, can indeed happen. A shock big enough such that for a moment we all go to the flexible price. It's very costly because everyone is going to pay the cost. But that's not what happens. It's a quantitative question and a good one. But I guess more generally, the philosophy is to understand that persistent is an endogenous object. It's not this one parameter that we pick from the shelf, we plug it in there, it worked between 2010 and 2019, why should it change? It's not a deep parameter. These firms are doing stuff because they want to, and when there is a big benefit of adjusting, they will adjust. Also, let me conclude by saying I focus today on an energy price shock. It's not because I believe inflation comes from energy price shocks. Deep down, I like Bob's views. I mean, I'm a monetarist. I believe that long-run inflation cannot occur without sustained monetary growth. And indeed, the fiscal and monetary premises of the environment are fundamental to understand inflation over the long run. This was just a narrow and well-defined exercise to understand a little piece of the transmission mechanism. Thank you.
Thank you very much. Let me wrap up by saying the following. You referred, Francesco, to this moment of beauty when the unobservable becomes observable. But you didn't just refer to this, you created a moment of beauty when you illuminated us on a number of things. And I will not repeat all of those, but some of them will echo. Large shocks are different. Large shocks travel fast. I think that you used the metaphor of a plane a little bit more sustainably. I would suggest as of now you speak of high-speed trains, but that is maybe the only thing I wanted to say there. And you reminded us that this might have policy implications. Sharon, you took us to supermarkets, but also to many people that use vouchers and have to spend their time and maybe waste their time on finding the bargains to make ends meet. And I thought that was a poignant reminder of what I said at the very beginning, that high inflation is very painful. And Gita yesterday told us that we are all waiting for our good friend, but for many people, stable prices are not just a good friend, but they are their best friend. And the only way to ensure that that best friend comes back is that we, in an unwavering way, as the President said this morning, and doggedly pursue our mandate. And with that, I close this session.
The world is going through profound changes. And this creates a challenging environment for central banks as we work to bring inflation back to our targets. We as central bankers must do our part to ensure price stability. And at the ECB Forum, from the 26th to the 28th of June, we will discuss how we can and will measure up to this task.
Hello and welcome back. A surge in energy prices has left Europe facing its most profound increase in inflation in a generation. It is unlikely to be the last time we see this. The war in Ukraine and the green energy transition are set to trigger unprecedented changes in one of the economy's most important markets. Central bankers must therefore refine how they think about energy prices and how they affect the outlook for inflation. This year's first panel will look at the latest thinking on how officials can better understand the implications of these shifts on their work. It will be chaired by ECB Executive Board member Isabel Schnabel. Dr. Schnabel, over to you.
Thank you so much, Claire, for the introduction, and good afternoon. I think we can say that now to everybody, especially, of course, to my four distinguished panelists. It's a very great pleasure to welcome you to our panel on structural change in energy markets and implications for inflation. So energy prices clearly remain a key driver of inflation dynamics in the euro area. The marked decline in headline inflation in the euro area was, to a large extent, driven by falling energy price inflation. And we saw that other inflation components like food prices and core inflation are also heavily impacted by developments in the energy sector, albeit with substantial lags. And at last year's Sintra Forum, we discussed the impact of rising energy prices on macroeconomic developments in Europe and around the world, and also the implications for monetary policy. So this year, as the President asked us to do, we are going to look a bit more into the future. So we are going to focus on the ongoing structural changes in energy markets and their impact on the outlook for energy prices and inflation. So what are the future shocks that we may need to expect going forward, and what kind of shocks will that be? So a discussion of energy markets is important as the volatility of energy prices is likely to persist for some time, especially given the fundamental changes to be expected in light of geopolitical shifts on the one hand and the green transition on the other hand. And this volatility is going to continue to contribute to the uncertainty of the macroeconomic environment, and it will also affect our inflation outlook. And for this reason, we as central banks are monitoring closely what is happening in the energy market, and we need to deepen our understanding of the functioning of energy markets and incorporate relevant structural changes also in our projection models. And to be able to do that, we rely on the support from experts like our excellent panelists, with whom I have the pleasure to discuss over the coming 90 minutes. Each of the panelists is going to make introductory remarks of no more than 10 minutes each, and then I will give the panelists a chance to react to each other before I will then open the floor for the Q&A. And of course, our online participants are also very much welcome to ask questions. So if you would like to ask a question, please raise your virtual hand. But let me start with the first speaker, who is Javier Blas. He is a Bloomberg opinion columnist based in London, dealing with energy and commodities. He's also the author of a fascinating book on commodity markets, The World for Sale. If you haven't read it, I recommend reading it because it's really fascinating. It's a different world, I would say, from the one we know. And this book shows quite plainly that Javier has an exceptional understanding of what is really going on in global energy and commodity markets. And so, Javier, we're very much looking forward to learning from you what's really going on in these markets. Thanks for being here.
Many thanks, Isabel, and thank you to the ECB for his kind invitation, and also thank you to the Banco de Portugal for his hospitality here in Sintra. I'm a Spaniard, and I can say that I'm absolutely marveled by this city, so that goes a lot, as Portuguese people will know. The views are all my own, including about Portugal. Global commodity markets have experienced extreme price volatility over the last 3 years due to several large consecutive and at times overlapping supply and demand shocks. In particular, the cost of energy commodities, including crude oil, natural gas, coal, and propane, surged to a nominal high in 2022, well above historical norms. And if I may have the first slide of the presentation. The price volatility was, no, that is, beg your pardon. There you are. That is the IMF Energy Index. It measures, as I said, crude oil, natural gas, coal, and propane. As you could see, the price spike was very significant and well above what we have seen in previous peaks, including just before the global financial crisis in 2007, 2008. That price volatility was amplified at times by disorderly trading in poorly regulated financial and physical commodity markets here in Europe and elsewhere in the world. The lack of circuit breakers meant that markets could suffer significant intraday price swings in some occasions, particularly in electricity and natural gas. Short squeezes triggered by record large margin calls also add significantly to the volatility, and in some cases what we saw was artificial pricing just triggered by the need to reduce positions due to margin calls and not for any fundamentals. I will make here an aside, if you allow me, based on this chart with data from the IMF. The IMF monitors 68 different commodities around the world. Crude oil, natural gas, coal, propane, in energy, wheat, soybeans, corn, metals, fertilizers. It does not, among those 68 commodities, include the price of electricity. And I see the same in some central banks, and I think it's a big miss on what we are seeing. In some ways, we are looking at the economy as we were still in 1973, and oil was the main energy of the planet, when electricity is taking over. Look at this room. The main source of this room is electricity, not crude oil, not natural gas. And if you look at particularly the service sector, think about what is the biggest energy cost of the service sector. On most occasions, that is electricity. If my hairdresser told me last time I was there that from the 1st of July, the price of my haircut is going to go 10% up, in part it's because that hairdresser is still adjusting to higher electricity prices. And contrary to what I have heard in previous panels, I will argue that the energy shock has not ended. I think that is still persistent, and consumers and small and medium companies in particular are adapting to a higher structural cost of energy, particularly for electricity. When you look at electricity prices, the analogy that I like to do is oil looks like a wave that hits you. You are on the beach, and it's a big, a windy day, and the waves are hitting you, and they will hit you on the face. They are very fast. They come very fast, energy, oil shocks. Electricity is more like the tide. It comes very slowly. It takes time. But if you are in low ground, you will drown also. And that difference is why I think that the electricity price shock is very important to monitor. Also because most consumers enter into relatively long-term contracts, 1 year, 1.5 years longer. And some consumers, particularly small and medium enterprises, enter into contracts last year at peak levels that they are going to stay with us for 12, 18 months. So it's going to take a significant amount of time before we see disinflation coming on electricity. I will focus in the next few minutes in a couple of areas. What happened in physical and financial commodity markets, and a brief summary of how those markets work, and also the important but I think unappreciated role of the commodity traders. First, on the markets. The commodity markets in reality are a complex web of interlinked markets. At different of equity and other security markets, we start with a physical market where goods are exchanged for immediate delivery. That is the spot physical market. Someone buys or sells a barrel of oil or a cargo of oil, a ton of aluminum, a bushel of wheat. And that is done today on the physical market without intervention of the financial market. We have also forward physical markets where physical goods are also interchanged for future delivery. And above all of those markets, that they are physical in their nature, we have financial or derivatives markets where participants can hedge risk, can speculate on the direction of the market. Those financial or derivative markets can be over-the-counter, bilateral, private, or can be done on exchange and clear. And at times, both markets are interlinked. You can take a position on the physical market, hold the contract to delivery, to expiry, and then take physical delivery of the commodity. So the financial market has a link to the physical market and vice versa. You also saw what happened on electricity and gas markets in Europe over the last 18 months, and those receive most of the attention by policymakers alongside with oil. But we have seen price volatility in many other markets, from nickel, commodity used for stainless steel, where we saw in London at one point the price move about 250% over a 36 hours period, although later some of the trade was cancelled. We saw it in the price of wheat, the price of soybean, and unfortunately we are seeing ongoing on the price of olive oil, which is a significant cost for my household. Why prices surged as much as they did? Well, there is a culprit above everything else, and it's the Russian invasion of Ukraine. Without that, we will not have suffered the amount of price inflation that we saw in the system. But there was significantly more to that. We have, in particular, in global energy markets, first, an unprecedented demand contraction during COVID. At some point, we lost 20% of global oil demand. No one was taking a plane. We were at home under lockdown. Later, the market, OPEC and other producers reacted to that, imposing production cuts to try to avoid excess surplus accumulating into the market. And the production cuts were historically large. It took a long time for us to see the impact of those cuts, but OPEC at one point cut more than 10 million barrels a day of production. That's more than 10% of global oil production in one go. That was the largest ever production cut I have seen from a cartel. Then demand reopened, the economies reopened, and demand came back, perhaps not as fast as it disappeared, but certainly it surprised many market participants. OPEC also decided to keep the market artificially tight in an effort, in part, to recover tons of trade. OPEC countries import a lot of their manufacturers, and they have suffered also for inflation. The purchasing power of the barrel is not what it used to be. A barrel of oil, I did recently an exercise, and I looked what is the purchasing power of a barrel measured by furniture from IKEA. It buys you exactly what it used to buy you in 2005. So you go to the till on an IKEA shop with a barrel of oil, impossible as it is. I don't think that they take that mean of transaction, perhaps Bitcoin, but not barrels of oil. You will not be able to get much of it. And OPEC is trying to reverse that negative tons of trade that is suffering. Electricity prices reacted for higher natural gas, expensive CO2 credit emissions, expensive coal. The price of coal, unappreciated, went from $100 to $400 in the space of 6 months. And also in certain countries in Europe, lower than expected nuclear generation and also hydroelectric generation. The impact of climate change not only at times increased the demand for electricity, perhaps for air conditioning, but at times also reduced the ability to produce electricity because we don't have as much water in hydroelectric installations. But there is also a bigger trend in energy markets that is very important and at times goes unappreciated. The global fossil fuel industry is investing enough for a world that is moving to meet net zero by 2050 demand and supply targets. And the supply is heading into that direction. Unfortunately, the demand is not heading into that direction. While the industry is investing for a world of net zero, demand continues to grow. And this year, most likely, we'll see record oil demand, record gas demand, and unfortunately also record coal demand. And that's interesting. The demand for coal in 2023 most likely will hit an all-time high. And that's coming many, many years after the first climate change initiative in the first serious one in Kyoto. Let me discuss now the role of the commodity trading industry. As commodity prices increased last year and also in 2021, we witnessed a massive transfer of wealth from consumers, and in many cases also from governments who were buying commodities on behalf of consumers or subsidizing them, to producers. What's largely missed in this debate is the significant proportion of that rent transfer went from consumers into the pockets of intermediaries, and those are the commodity traders. And by commodity traders, I don't mean big Wall Street investment banks, but I mean a small group of companies, most of them privately owned, most of them also headquartered here in Europe, that buy and sell physical commodities, and they hedge and speculate also in financial markets. The financing of this industry is also largely coming from Europe. It's done by European commercial banks, not big investment banks, but actually the kinds of banks that will have a high street office and will extend a mortgage to consumers like me. How profitable was 2022 for those commodity traders? Well, that's how profitable it was. Those are the 4 largest commodity traders. I should say that some of those commodity traders don't only trade, but also produce some commodities. They mine, they perhaps produce some oil, or they are in the meat packing industry. But Glencore is the world's largest commodity trader, largest metal trader, Vitol, largest oil trader, Cargill, largest grain trader, Trafigura, big player in both oil and gas. And you could see the volatility, you could see the net income. That is profit after tax in billions of dollars. We don't have many data on the industry. It's very opaque. Most of them are privately owned, so they don't have to report. But that is paradigmatic of the rest of the industry. You ask a CEO of the commodity traders, and you will get similar information from other companies. Return on equity, that most businesses will be happy to have return on equity of perhaps 10, 15, 20% return on equity. Return on equity for many in the industry was 100% last year. In some cases was 200, 250%. These are highly leveraged businesses. The recipe for obtaining these margins, those profits, is very simple. You buy and sell many, many times in different locations, in different forms, and try to make a buck, exploiting and arbitraging the price difference. For that, one needs to take risks, and at times, significant risks. And last year was very risky. We don't have many data about how much risk, value at risk the industry takes, because again, these are privately owned companies in general. But we have data from Glencore, which listed in 2011 in the London Stock Exchange, and is headquartered in Switzerland. And as you could see, value at risk for Glencore, this is 1 day, 95% interval, average for the year, exploded in 2022. At some point, Glencore, very similar to many others in the industry, lifted completely all their value at risk limits, and they traded without any limits whatsoever. That is the average value at risk for the year, which I think, if I remember top of my head, is $158 million. But the peak, the single day peak, was $451 million, and mostly on the back of LNG and gas trading. And with this industry, that seems quite important to understand energy commodity markets, how much we know about them, how we regulate this industry. Well, let me tell you that the commodity traders have largely escaped regulatory scrutiny in the European Union. And that's not my statement. I have a much better source. That's what the European Central Bank said in a review 6 years ago. We also know that the sector is opaque, is highly leveraged, and suffers from liquidity mismatches. That also comes from the ECB. The IMF told us earlier this year that some very large traders are private companies. They are subject to very limited or no public reporting requirements. And what worries me the most is what we don't know that we don't know about the sector, particularly considering the size of the margin calls that we saw last year, some market failures and exchange failures like the London Metal Exchange. And those unknowns, as our famous Secretary of Defense of the United States used to say, is what worries me. And considering the experience of the last 3 years, I think it will be better that we know more about the sector. Is regulation needed? I will leave that for you policymakers to decide. But I will argue is that we need more oversight and that the commodity trading sector is too large to ignore. Thank you very much.
Thank you very much, Javier. So this brings me to our second speaker. I'm delighted to welcome Christiane Baumeister, who is Lambert Family Professor of Economics at the University of Notre Dame. And she's also an empirical macroeconomist and a leading expert on the dynamics of energy markets and the transmission of monetary policy. And in her remarks, she's going to focus on structural changes in global oil markets and what they imply for inflation. So Christiane, thank you so much for joining us today. The floor is yours, and I would be very grateful if you could stick to the 10 minutes.
Okay.
We don't see the time here, so that's a bit...
Yeah, that's a bit the problem. Well, thank you so much for the introduction. It's a great pleasure to be part of this panel. Well, the outbreak of the COVID-19 pandemic in early 2020 set in motion a sequence of structural changes in global energy markets, which were reinforced by the Russian invasion of Ukraine only 2 years later. Now, these dramatic events triggered unprecedented policy interventions and played an important role in the recent surge of inflation. And that's, in a nutshell, what I'm going to talk about today. So let's start by looking at some of the changes on the supply side of the global oil market, where I will focus on the world's 3 largest oil producers, the US, Saudi Arabia, and Russia. The US shale oil sector has been hit very hard by the pandemic, and production growth since then has been very slow to pick up again because of the existence of a number of physical constraints and demands from the corporate side in terms of imposing capital discipline and generating returns for shareholders. In fact, the US shale oil sector has shifted to a new business model that prioritizes generating returns for investors over expanding production in response to higher oil prices, which used to be the status quo before the pandemic. And this is also reflected in indicators of drilling activity, which, while recovering from the pandemic, recently show a reversal and a marked slowdown. So the key takeaway here is that the U.S. is likely not going back to its earlier role as the new swing producer. And in fact, the pendulum has swung back to some extent to OPEC under the leadership of Saudi Arabia. Now, one issue that has become evident during the recovery from the pandemic is that some OPEC members really struggle to fulfill their quotas. So there is consistent underproduction from a number of member countries, which together with the low levels of spare capacity limits OPEC's flexibility to stabilize the market. And while you can see from the graph that spare capacity has been low before the pandemic, what is new and what needs to be taken into account is that in this new setting, where other major oil producers face enduring constraints, and here I'm thinking in particular of the US and potentially Russia, as I will detail in a moment, that kind of, the severity of this lack of spare capacity has increased. The Russian crude oil market is undergoing also a major transformation since the invasion of Ukraine. Now, as Russia lost its traditional customer base, in particular Europe, the composition of its buyers has changed quite dramatically, as you can see in the graph below here, where China and India are now the top importers. The first line indicates the start of the war in Ukraine, and the blue part, which stands for the EU, has decreased dramatically. Now, this change in the composition of importing countries has led to a redirection of global oil flows and also a fragmentation of Russia's export market into 2 different geographic segments, which feature very different price and demand dynamics. Now, the demand side obviously has also responded to the developments over the past couple of years with several policy interventions in order to promote the stability of the global oil market and to counter global inflationary pressures. And I will limit myself to discussing just two here. The first one is the EU embargo and the G7 oil price cap that was introduced in December of last year. Now, the underlying idea of the price cap is that Russia still has access to Western shipping services, but only if the cargoes that carry Russian oil are sold at or below the price cap, which is currently at $60 a barrel. Now, the objective here is a dual one. On the one hand, we want to make sure that the market remains well supplied and avoid a price spike, while at the same time curtailing the fiscal revenues for Russia that it uses to finance the war in Ukraine. Now, after 6 months, 6 months after its implementation, it's maybe time to take stock of the effectiveness of this price cap mechanism. And so far, it turns out that seaborne export volumes remained relatively stable. And if anything, have increased, as you could see on the chart that I showed you before. And there was also no material impact on the global price of crude oil. But there have been important impacts on the prices for Russian crude, which differ greatly across locations. In fact, as a result of the market fragmentation that I mentioned previously. So shipments from the Baltic Sea and the Black Sea now sell at a discount because of the change in customer base, so you need to entice India to take over the shipments that were lost from the EU, while transactions that happen in the Pacific Ocean, they tend to exceed the price cap. Now, what did that imply for Russia's revenues? Well, at first, in the first quarter of 2023, we actually saw a marked decline, but recently revenues have been on the rise again, and that's mainly due to the narrowing of the price spread between Brent and the Western benchmark at which Russian oil sells, and also export volumes shipped by sea have increased. Now, the second intervention that I want to talk about are the unprecedented releases of oil from government-controlled emergency stockpiles. So what clearly stands out here is the large scale and duration of these drawdowns. So for example, the US Strategic Petroleum Reserve started from 600 million barrels in the aftermath or during the, as you observe, after the recovery from the pandemic, and it has decreased to a historic low of 350 million barrels right now. But recently, the U.S. has started the process to refill the Strategic Petroleum Reserve, which down the road will create additional demand for crude oil. Now, I will now kind of like leave the more physical side of things and turn to prices, where I will decompose the oil price fluctuations associated with the events that I mentioned into supply side and demand side factors and quantify their contribution to price movement. So here you see the Brent price, which reached a trough of $18 a barrel in April and peaked at 122 in June of 2022. And over this period from April 2020 to December 2022, where the sample for my econometric model ends, we saw two episodes where supply played a major role, and here I'm filling in the quantitative evidence of the narrative that Javier mentioned before. So when OPEC Plus cut production by 10 million barrels per day in the early stages of the pandemic to lift prices off the floor. So we see that more than half of that price increase can be attributed to supply. And the second episode is related to the outbreak of the war, where also supply factors are the main driver. Now, we also have one event where supply-side forces prevented prices from falling further, which is between October and December. Now, over this period, there were 3 time periods where demand was the dominant factor, accounting for over 80% of price movements of crude oil. Now, what I want to do next is to, and they line up again with the narrative of the pent-up demand, and then we even see that demand is still the major factor in the run-up to the war. So when tensions in December became first apparent, and then until the outbreak of the war, and then also when oil prices came down, so it was mainly due to a reduction in demand. Now, what I want to do next is to look at the same periods that I examined here for the price movements, and to look at the contribution of oil supply and demand shocks to inflation in the US and the euro area. So I chose as a starting point, I chose a different starting point for the US and the euro area for that first episode that aligns with the time when inflation started to overshoot the target, because we're interested in seeing how much oil shocks mattered for basically excessive inflation. So I just highlighted, in the interest of time, a few periods here. So what you see, or the key takeaway from this decomposition, is that in the initial period, both in the US and the euro area, so when we were recovering from the pandemic, oil demand shocks contributed substantially to inflation. So in the euro area, it was about 50%, while most of the time oil supply shocks did not matter that much, except for the early stages of the war in Ukraine, where they actually made a quite substantial contribution to the additional increases in inflation. Now, they are also relevant for inflation coming down. So inflation came down in the US by 1.3 percentage points in the last quarter of last year, and about half of that can be attributed to demand shocks. The contribution in the euro area for that first reversal of headline inflation is a bit smaller. Now, however, oil supply shocks is what keeps policymakers, I guess, awake at night, because, as we heard already this morning, they generate a trade-off between inflation and output stabilization. So I want to also look at the dynamic effects of a 10% increase in oil prices due to a supply shock on headline inflation. So what you see is that both in the US and the euro area, inflation jumps up on impact by relatively similar amounts, reflecting the energy share of headline inflation. But then the pass-through is much faster in the US, while in the euro area, inflation takes a while to increase, and then is more persistent, which points to important second-round effects. Now, an important transmission channel are inflation expectations, so I also want to see how they are affected in both areas. And here I take 1 year ahead household inflation expectations, which, as you can see, react much more strongly on impact in the US, but then the effect dies out relatively quickly. Whereas once again in the euro area, the buildup is much more gradual and long-lasting, which seems to suggest that higher oil prices get much much more ingrained in expectations in the euro area compared to the US. And I also have evidence for the long run market-based expectations, but there the effect is much smaller, albeit very persistent. But so the last thing that I want to point out, and I'm going to wrap up with that, is that something that matters a lot for the euro area is, of course, that we're looking here at the area-wide response of inflation expectations, but underlying this response is a lot of cross-country heterogeneity, and here I show you evidence for the 19 member countries, so I apologize to Croatia. I excluded it because it only joined or adopted the euro at the beginning of this year. So, but what you see here is that the sensitivity of inflation expectations varies quite a bit across member countries, both in terms of the magnitude, which you see on the left panel, which is a snapshot at a year after the shock for all the countries, but also in terms of dynamics, which is on the right-hand side. So there you see the month of the maximum response, which tells you something about the speed of pass-through. So I just, yes, I'm going to leave you with that impression of the heterogeneity, and thank you very much.
Thank you very much, Christiane. So our third panelist is Miguel Gil Tertre, who is Chief Economist in the Directorate General for Energy at the European Commission. So he is the person responsible for modeling the impact of energy-related policy proposals and for ensuring that they are economically coherent. So he's a very important person at the Commission. And Miguel will briefly review the Russian gas crisis and the EU's policy response. But then he will also analyze implications of the change in the energy mix, offering a longer-term perspective of the green transition. So it's great to have you here, Miguel.
Thank you very much, Isabel. Indeed, I mean, my first message today is that last year, energy crisis was not related to the green transition. It was not a clean energy or a clean technologies crisis, but clearly a Russian natural gas crisis. There are three reasons why prices increased very significantly during 2021 and 2022. The first one, the very significant reduction in supply from Russia. We went from importing around 40% of natural gas supplies from Russia to around less than 10% today, so from 155 billion cubic meters to less than 40 today. The second reason was the uncertainty and the fear of shortages that ensued, and in particularly this you can see in the slide in the period between July and September 2022. And the third reason is the lower than usual hydro and nuclear output for electricity in the summer as well that push natural gas consumption for electricity generation. So this increase in the prices of natural gas drove the increase in electricity prices, and that had effects on the overall economy. Had we had more renewable energy sources, we would have been able to displace gas a longer number of hours from our electricity generation mix. If we would have had more solutions like heat pumps for heating our homes, we would have had lower demand for gas, and therefore prices would have been lower. So on the contrary, clean technologies would have shielded us better. Now, if we look at this period in summer 2022, I think it's important also to mention that prices above global levels were instrumental in attracting liquefied natural gas, but the extremely high prices that we paid between July and September 2022 were not strictly necessary from the point of view of security of supply. The high spike that we saw in the summer of 2022 was due to intra-EU competition, in this context of fears of shortages, that met with infrastructure bottlenecks in the northwestern region in Europe. I mean, since then, A lot of new LNG terminals have been built. The capacity to bring flows in the Northwestern Europe region has eased and is better, but other parts of the world were not paying these very high prices that we paid in the summer of 2022. And this, as Javier was mentioning before, benefited mainly those trading the assets. Now, what about next winter? So here we come with the positive news. Similar spikes as those that we experienced in 2022 are less probable this year, all things being equal, for 5 reasons. The first one is the high storage levels. If we continue with the refilling of storages as we are doing today, and we have a framework, the EU adopted a framework about minimum storage levels, by mid-August, end of August, our storages are going to be full. Therefore, we will need less gas during the winter 23-24. The second reason relates to natural gas demand reduction. We have a framework in place. We have consistently reduced by 18-19% our consumption of natural gas. And part of it is structural. I mean, prices have gone down. We're still with high prices. So we are not seeing demand coming back. And certainly something very important, it was not the weather. I mean, this we need to be very clear, because there are a lot of narratives out there saying that Europe got lucky. I mean, the 5 years previous to 2022, 2023, to this winter, were not that, let's say, warmer. Third element, more infrastructure has been added to remove bottlenecks. We have 30 BCM, billion cubic meters, additional regasification capacity in the EU. This has been delivered in a record time. By 24-25, we will have 45 BCM, so we will be able to accommodate more liquefied natural gas. And there has also been an acceleration in the deployment of renewables with 56 gigawatt of additional capacity. The fourth reason is that there is a lower possibility from Russia to weaponize energy markets. As I said, I mean, they have moved from 45% of our supply of natural gas to less than 10% today. And finally, a very important point again, less uncertainty. There is no fear of shortages. I mean, these reports about European homes not being able to heat or blackouts in the electricity system have been avoided, and they don't seem to be coming back. Now, if we look at 3 lessons that we learned from the crisis, the first one I alluded already to, which is the fact that more renewable energy sources can help limiting price spikes due to fossil fuels if they are able to displace the gas from the electricity generation, but it will take time. And I think it's important to understand that by 2030, and this is the modeling we have done with my team, while renewables are expected to provide more than 2/3 of the electricity, fossil fuels would still set electricity prices during half of the hours, and even increasing in some member states. So we need to accelerate very much this deployment of renewable energy sources to be able to grasp the benefits of their lower generation cost. Now, the second element is that the pass-through from wholesale to retail energy prices differs very significantly across member states. Why? Because actually, it's just a fraction of the retail price, the wholesale price. I mean, 1/3 are taxes. So this is something that helped member states in addressing the crisis. But the way this taxation happens is very different across member states, and therefore led to a significant heterogeneity in the way prices for energy responded. And the third element is that futures, while an important indicator on market expectations and reflecting market sentiment, in a context of a turbulent market, they need to be complemented with an analysis looking at supply, for instance, the additional capacity coming from LNG terminals, and demand condition, lower demand due to the installation of heat pumps. Now, if we look at the future, the energy sector is undergoing a massive structural change. Javier alluded to it. At some point, I mean, oil is going to lose its importance. We need to look increasingly at renewable energy sources and electrification So three elements or three very important factors is that we will have less energy consumption in the future. The total energy consumption will decrease by 1/3 in the EU by 2030. Second element, electrification. The share of electricity in the final energy consumption would increase from 23 to 33% in 2030 and 60%, as I said before, in 2050. More renewables and less gas to the mix. And obviously, when we analyze prices for energy, we need to look at these important changes. An important slide from my side is that there is clearly a need to differentiate the short-term contribution of energy to inflation from the long-term structural changes from the green transition in relative prices. As the previous speaker has mentioned, there's going to be more regular price spikes in the future if there are mismatches of supply and demand of fossil fuels, and this can happen irrespective of the green transition. So it's important when we analyze the prices of energy to differentiate these two aspects, and also important to differentiate the impacts during the transition from the structural effects once the transition has been achieved. And given the large number of different effects, when looking at these price impacts, it's important to look at different dimensions. First of all, commodities. In the future, the central assumption is that prices paid by the EU on both fossil fuels and critical and raw materials necessary for the green transition will be set in international markets. The green transition requires technologies that are very mineral intensive, and the EU depends very heavily on a few countries for these critical raw materials. For instance, the EU gets 98% of its rare earth supply and 93% of its magnesium from China alone. At the same time, we will still need diminishing volumes of fossil fuels during the whole transition, and as shown by this, by the recent crisis that we had, this can have a very significant impact on electricity prices, even if they are diminishing. The second point is that in order to reduce vulnerabilities, since we need to work on diversification, we need to work as much as we can with supply, but we have limited possibility to impact supply, we need to work on lowering demand and electrification. There, as I mentioned before, there's going to be a lower demand for energy in the future, and there is also the development of energy efficiency solutions. Demand response and self-consumption are going to be extremely important. Lower cost on electricity driven by renewables, I already alluded to. Replacement of capital stock and infrastructure. According to our modeling, in the energy sector alone, we will need 487 billion euros of investments per year. This can push prices up of green goods, and moving before other regions in the world can moderate these price tensions. Shortages on the skilled labor force might create also upward pressure on prices. But there will be ultimately a readjustment on relative prices. Carbon pricing and taxation. Increasing the cost of carbon can have an important impact on prices. Using the revenues for public investment in clean technologies could lead to a positive supply shock. And the current taxation systems in member states, they need to be adapted. Because currently fossil fuels are heavily subsidized, while at the same time electricity is heavily taxed. When electricity decreases in the future, this can have a downward impact on prices. And finally, uncertainty and higher risk premiums. Changes in the cost of capital can impact the future energy system. Certainty is crucial. So my conclusion is that poorly sequenced or erratic changes during the transition will be accompanied by episodes of very volatile prices. Policy choices matter. We need to avoid uncertainty as much as possible, cheap and stable access to commodities, manage demand, and install renewable energy sources as soon as possible. Thank you.
Thank you very much, Miguel, for a very interesting presentation. And my final speaker is Ida Wolden-Backe. who's governor of the Central Bank of Norway, which is a country that was very differently affected by the energy price shock. And Ida will bring the perspective from a major energy exporting economy. And as a central banker, I assume you will also talk about the implication for monetary policy. So Ida, the floor is yours. We're very much looking forward to hearing your insights.
Good afternoon, and thank you so much for inviting me to participate in this distinguished panel. So in my remarks, I will offer some thoughts on how the structural changes in energy markets will affect energy prices and inflation more generally, before turning to some implications for monetary policy. But let me start by sharing some observations on my home country. Now, Norway is an energy nation and a large exporter of oil. Over the past decade, natural gas exports have increased in importance. Also, Norway is highly integrated in the European energy market, primarily as an exporter of oil and gas, but increasingly also as an important supplier of flexible hydroelectric power. Now, since Russia's invasion of Ukraine, Norway has become Europe's largest single gas supplier. A close cooperation with Europe reflects our common interest in well-functioning energy markets during the transition to zero emissions. Now, in the years to come, the petroleum sector's significance to the Norwegian economy will likely decline as resources on the Norwegian continental shelf are depleted. And lower activity in the petroleum sector will have implications for the Norwegian business structure. Substantial investments and reallocation of labor and other resources across sectors and firms may be required. But along this path, the green energy transition can be a catalyst. And we're already seeing that technology developed in the petroleum sector serves as a springboard for new jobs in the green sector. So turning to the next topic, how are structural changes in energy markets shaping the outlook for energy prices and inflation more general? And on this is my time to be humble and say that predicting the energy prices in the years to come is extremely hard. As we've already heard, different aspects of the transition are likely to affect different prices differently and possibly with opposite signs. And outcomes will depend on developments of technology, the supply of raw materials and minerals, and on political decisions, not only related to the climate, but also related to energy security. While recognizing that uncertainty, I think in the short to medium term, it would be prudent to be prepared for, at least, a potentially higher frequency of negative and possibly more persistent supply-side shocks originating in the energy market. Now, with an increasing share of intermittent renewables in the energy mix and insufficient energy storage system to act as balancing mechanisms, supply could become more unpredictable. And coupled with low demand elasticities, short-run fluctuations in supply could potentially trigger large price movements, reinforcing a well-documented characteristic of energy markets. Now, turning to how this might impact inflation, although household energy costs constitute a fairly modest share of the CPI basket, as we all experienced last year, large movement in energy prices can have a material impact on headline inflation. And energy prices, as we've also heard earlier today, can also have an indirect effect through firms' input costs. And large and potentially more persistent changes in energy prices may limit firms' ability to absorb such large costs via lower profit margins. And the pass-through from firms' input costs and ultimately to consumer price inflation may then be amplified. Large and more persistent energy price changes could also amplify second-round effects, for instance, by affecting inflation expectations. Recent research that we've already heard, but also at Norges Bank, have found that household expectations play a key role in amplifying the pass-through of oil price shocks to inflation. And this is particularly the case when oil price changes are large and persistent. On the other hand, and contrary-wise, at least some of the pass-through to core inflation will be counteracted by the disinflationary effect of lower income and a fall in demand. As many households are credit constrained and consume mainly out of current income, larger and more persistent energy price movements could therefore potentially amplify the contractionary effect on consumption. So how will this affect monetary policy going forward? Now first, central banks need to deepen their understanding of the functioning of energy markets. And we need to integrate that knowledge into our analytical framework. The effects of and the efforts to combat climate change might change the structure of our economies in ways that reduce the relevance of existing models based on historical data. And furthermore, going forward, it will be crucial to identify the source and the nature of the shocks behind the energy price movements in real time. And this may become more challenging as the green transition involves a wide range of sectors and products. So to help us navigate, we need more research, possibly new analytical tools and new models. Now, central banks are not unfamiliar with fluctuations in energy prices. But should the frequency and persistence of supply shocks in the energy market increase ahead, we may be faced more often with a challenging short-term trade-off between stabilizing output and stabilizing inflation. And deciding on the right timing and dosage of monetary policy will be crucial. As we've heard earlier today, the appropriate response of monetary policy to energy prices will depend on the source and the nature and the duration of the shock. It will also depend on whether energy price shocks fuel inflation via second-order effects, including through inflation expectations. And failing to respond to such second-order effects, we may risk persistent overshoots of our inflation targets and ultimately a de-anchoring of inflation expectations. On the other hand, wrongly interpreting temporary movements in energy prices as having persistent effects, we could incur larger output losses in the short term and may even increase inflation volatility. Moreover, changes in relative prices, for instance, due to higher carbon prices, are effective signals that drive the transition in the right direction. An appropriately flexible and forward-looking monetary policy would help those necessary changes in relative prices to feed through. But flexibility must not come at the expense of credibility. In presence of structural changes and large uncertainties, such as those created by climate change, well-anchored inflation expectations remain as important as ever. I'll stop there. Thank you.
So thank you very much to the four panelists for excellent presentations. Actually, if I may, I would like to start from a comment made by Ida. So you basically said that you would expect there to be more frequent and more persistent energy price shocks, during the transition period, And I would like to hear whether the others agree to that, or how you would see that, how the structure of the markets affects that. And then maybe also to Miguel, because you took a bit the longer term perspective, what is going to happen after that, and how long do you think this transition period is going to be? So if whoever wants to come in.
Yes, I guess the question was
no,
for
it's
the
actually
other
more to the others, because
yeah.
you made this
But
statement.
let me just
yes.
emphasize that at least I think, I mean, there's great uncertainty about the outlook for energy prices. But I think it would be prudent to at least prepare for the possibility that we might see more persistent and more frequent negative supply shocks in energy markets. But that's not a given that will actually happen.
I would say I share that view kind of like in terms of my more current analysis of how the major oil producers are shifting in terms of the market structure and the way. So they kind of like becoming in a way more prone to supply disruptions. And so, yeah, I would kind of like share the view that Ida mentioned, that supply shocks are going to be more frequent, and it is indeed prudent to prepare for that possibility.
And you're talking about the oil market specifically.
Yes, but I think it's a broader phenomenon. So,
okay,
yeah.
Javier?
I fully agree with the comment that Ida made, and I mean, one of the difficulties, in particular in the electricity market, to predict where the price and the supply and demand is going to be is that you need to take a view on the weather. You need to forecast what the weather is going to look like 2 weeks from now, and that is very, very difficult beyond most of the tools that we have. It was the case that we have only to model the weather because of the demand. Is it going to be hot? We are going to need more demand for air conditioning. It's going to be cold. We are going to need a lot more demand for heating. But today, increasingly, we need to model also for supply. Is it going to be windy? Is it going to be sunshine? Is it going to be cloudy? We're going to have a reduction in solar production is becoming more and more important in many European countries, particularly in the south. And that is having an impact. And the impact of weather, both on the supply and on the demand, and the difficulty to predict weather more than 10 days ahead makes that more difficult. The solution will be storage, but we are not there yet.
Thank you very much. Maybe you can also comment a bit on this, you know, the longer term perspective that maybe is a more benign one, actually.
Well, I mean, I think there are two sources of volatility that we might see in the years to come. I mean, one which was alluded is the mismatch between supply and demand related to fossil fuels, and also the fact that concentration of these diminishing volumes of fossil fuels might, you know, be in 2 or 3 countries in the world mainly. And then there is the volatility that is inherent to the clean technologies that Javier was alluding to. It's the fact that if there is no wind, if there is no sun, we might need, you know, other things there. Innovation, demand response, flexibility, batteries are extremely important. And also, as I mentioned in my presentation, to secure this base load that you need for electricity, be it gas, be it nuclear, that would still be needed. Now, what on the benign side, because you were asking about that, we are seeing an acceleration of the deployment of clean technologies after this crisis. I mean, this I mentioned before, we are in a record level of the deployment of renewables. We're also in record level in several member states on the deployment of heat pumps and other solutions. So this part on the and I mean, will require also a very significant investment on grids that we are not seeing. But I think in several member states might come, you know, earlier than expected. So by 2030, 2031, 2032, we will start seeing dramatic changes. Yeah.
Okay, so you mentioned the investment that is needed. There's, of course, one debate ongoing whether central banks, by raising interest rates forcefully, whether we may actually make this transition harder. Maybe, I don't know, Ida, do you have a view on this?
Well, I guess higher real rates would make all investments more expensive. So it's not obvious to me, although the horizons might differ, of course, how this will play out. But I nevertheless think that the most important contribution we can make is to make sure that inflation is low and stable, as that will also benefit those investments. And then providing for a stable economy and low inflation is perhaps more important in the long term.
Yeah, very good point. Any other comments you would like to make to each other after your excellent presentations?
I would like to follow up on one point that Miguel made, which is about the pass-through from wholesale to retail prices differs across member states. So, which is the case in different energy markets. So that was my last point also about the heterogeneity in the pass-through. And it's important to be mindful of the fact that this depends very much on the economic structure. So we have been talking about structural changes in the energy markets, but we also need to take structural changes in economies with regard to the energy mix into account, which is, for example, one factor that determines heterogeneity in pass-through. Others are kind of like changes in the industry composition, the competitiveness of the environment, kind of like so how competitive the environment is in which firms are operating, and also national government policies like energy subsidies, taxes, and things like that. So there is scope also for, I guess, some policy interventions that could kind of like make countries more converge on that front, which then should also make the job for the ECB easier, kind of like to intervene in the case of the more frequent energy supply shocks that might happen down the road. So I just wanted to reinforce that point because I think it's important.
Yeah, I think that's an excellent comment because indeed, of course, we've been struggling quite a bit with all these heterogeneities across different countries with the very different speed of the path-through that was also shown in the slides, and I think that's an extremely important point.
I will perhaps make a quick point on following on Miguel's comments about the lack of forecast power of the forward curve in commodity markets, and I think that a lot of the errors on inflation forecasting across the industry, not just in central banking, my own included, over the last few months have been for relying too much on forward curves as an input for our inflation forecast. I know that if we take away the curve and what we replace that with, and I don't have a very good answer on that, but I know that perhaps relying too much on forward curves is making us predicting inflation wrongly.
Yeah, I mean, we've had that discussion also internally, if I may say. But actually, you mentioned that you are doing analysis that goes beyond the forward curve, so that you are looking at, what are the expectations about how demand and supply is going to develop. So do you have anything to offer to us, what we can use instead of futures curves?
Well, I mean, we're working with my team very much, and we are in touch with the teams in the ECB on this, but it's basically to have a qualitative assessment on the supply and the demand conditions. I mean, if we know that the storages are going to be full by the end of August and that we might not need that much gas, we can have an assumption that prices might decrease for natural gas. I mean, this is one of the scenarios that we are developing ourselves for the end of August and the beginning of September, all things being equal, considering, as I mentioned, demand conditions, that we don't need that much gas anymore, the forecasts that we had also on the weather. So all of these elements, they allow to a little bit, in a sense, qualify what the forward curves are telling us. Yeah.
Yeah. No, I mean, it's actually, I find it quite fascinating to see that now we are becoming so dependent on weather. I mean, weather it affects energy prices more and more, but of course it also affects food prices. At the same time, we're seeing all these things happening with El Nino, with climate change and all these things. I mean, that is interesting that the weather is going to be one of the major uncertainties going forward. And I think probably we are not going to be better in forecasting the weather than we are at forecasting other things. So that's it's a bit concerning. But any other comments, or shall we open the floor? Ida,
one
yes.
brief remark, and what my fellow panelists reminded us is that it's obvious, of course, but there's not just one energy price or one energy market. And I think my panelists did a good job of explaining that, and why we also need to expand our analysis at central banks, and recognizing that different markets affect different firms and different sectors of the economy differently, which also makes this quite a challenge.
All right, so let's go to the floor for question. So I don't see any question on Zoom. So please, yes. We need a mic. Actually, we have 3 questions right here. We collect the 3. Yes, Richard, to you too. I don't know who wants to start. So, Javier.
Thank you. Fernanda Guardado from the Central Bank of Brazil. We can definitely see how we are depending on the weather. We have a lot of hydrological power, and when there's a drought, we get very strong increases. But I wanted to dial back to Ida's comment on the shocks becoming more frequent. So making a link with that, with the first panel, and trying to identify whether shocks are temporary or kind of frequent enough to be considered permanent, would you say that maybe this is one area where we should consider a higher frequency of shocks in prices of energy and oil to be more permanent, and include that in our framework in such a way that this is maybe requiring higher neutral interest rates, so that we don't pass through the volatility from oil prices and energy prices into monetary policy? So maybe this is a more permanent development, and maybe this should be included as such in our evaluation. So maybe if you want to comment on that.
Yes, very, very interesting question. So, Javier.
Xavier Vives from ECB Business School. I'd like to go back to the relationship between the green transition and the pricing dynamics, which you have, most of you touch upon, because this is going to definitely be tricky. And one issue which I am not clear, and I would like to see your opinion, is that, well, we all agree that we have to decrease, the use of fossil fuels, but how to manage the transition and the needed investment still in those fossil fuels, so that the lights still go on always, basically, and in this respect, I think, Miguel, so you have pointed out that the role of the Russian aggression on the natural gas prices and so on. But if we look at 2021, the year before, prices of energy were going up. This was not Russia. And it was because of weather, obviously, the weather, the increase in demand in Asia, but also because of the increase in the prices of CO2, which that's what we have to do, right? The prices of CO2 have to go up. So here we have some dynamics, that how to ensure, that this goes as smoothly as possible.
Yes, very good question again. Richard, please.
Thank you. Richard Portis, London Business School. A quick remark on the weather. Ken Arrow did weather forecasting during the war. 40 years later, he said that it hadn't improved. Beyond 48 hours, weather forecasting hadn't improved at all. 2 questions for Javier. I was really struck by the information you gave us about the commodity trading houses. And now I understand why Glencore is so often in the financial pages of the newspapers. But first of all, do you think that these activities, that the trading house activities, actually contribute to arbitrage, to a positive, to some positive consequences in the markets? And second, this huge increase in their revenues, can you tell us anything about who's actually paying that? What's the distributional effect of this immense rise in the revenues of the trading houses?
All right, so who would like to take any of the questions? Yes, please.
I can start, with the point that Xavier was mentioning. I think we need to provide as much certainty as possible and clarity on what is the demand we're going to have for fossil fuels, and enter, as we are doing it already, I mean, with our joint purchasing mechanism, from the Commission, entering into partnerships with countries in the world that would have to supply us, so that they know until when we will need these amounts of fossil fuels, so that investment can follow. Investment not necessarily in new drilling and new, but keeping simply the facilities. Now, an important point from my side is that, I mean, prices already in the summer of 2021 were increasing due to Russia. It was not, that prices increased at the moment of the aggression of Ukraine. In August 2021, we started noticing that the storages in several member states that should have been filled by gas coming from Russia were not being filled. And that's what puts us in a difficult situation, because we ended up in the winter 21-22 with storages only filled at 30%, and that puts us in a lot of difficulties. And related to the ETS price, I would say the same. I mean, we need to provide certainty. We believe in this tool; it's a market tool, and I think it's delivering. We need to be as certain as possible about what is the path on the allowances. Thank you.
Thank you. So, do you want to take the monetary policy question, or?
That was a very interesting question, but one that is difficult to give a definite answer to. In the sense, I think in real time it will be very challenging, of course, to identify whether a shock is temporary or permanent, as we've already discussed this morning. And then I think there's in general, a very interesting question related to the transformation of energy markets and the green transition, and how if that would impact a neutral rate of interest. I think is an ongoing discussion where there are effects could go in potentially different directions.
So that's for next year's panel. Javier?
Thank you for the questions, very, very pertinent questions. You want to ask, thinking about, is a positive arbitrage for society and the economy? You ask that question inside the industry, they will tell you that they are the visible manifestation of the invisible hand, that they are doing the job of the market and they are redistributing commodities. Certainly the industry is as old as mankind, commerce and trading commodities. We started with the stones and copper and iron, and we have continued now with everything else. There is a degree of need of the industry, and certainly at times, last year in particular, there was a need to reshuffle global trade of commodities. Oil from Russia was not coming to Europe anymore. It was sent to India, where it's refined, transformed into diesel, and then re-exported to Europe. Whether that's a good policy, I will leave it to the room. But there was a need for the traders. The question is, are they profiting in excess? In the commodity trading regulation in the United States, there is a terminology that is excessive speculation. Was excessive arbitrage on the industry? Looking at the profitability, one will think that the profits at least were quite good. And in terms of who is paying for this, well, it's coming from consumers, it's coming from producers. Mainly, if I look at last year, my initial reaction was that most of the profit was coming from consumers, were the consumers paying for those extra profits. And I will make an additional point here. I'm going to get a lot of emails from the CEOs of some of the commodity trading houses for this, but I will say it nonetheless. In Europe, we discussed and implemented some windfall taxes on the profits of big oil companies, big gas companies, and included we capped the profitability of some green energy generators, particularly in the wind industry. There was no windfall tax on the commodity trading industry, mostly because it's located in Switzerland and also headquartered in Switzerland, but very important, most of the times the final incorporation of those companies is often on low tax jurisdictions, Singapore, British Virgin Islands, Cyprus. And so that was one point. And because they operate from those locations, the tax that they pay to society is relatively low. The average tax margin for these companies is about 10%. Wall Street pays about 25%, Wall Street banks. They compare very well with Goldman Sachs in terms of taxation. And I will leave it there before I get more emails.
So I have 3 further speakers. I know everybody is hungry, so, okay, 4.
I have 4. I close the list here. So I have Anil first, then Daniel, then Lucrezia, then Joachim.
Anil Kashyap, University of Chicago. This is for Miguel and anybody else who wants to answer. I mean, the one thing that hasn't come up this far is it makes no sense for a lot of the fossil fuel countries to leave it in the ground. So at some point, there are incentives to try to harvest some of that revenue before things become completely inviable, kicks in. And I'm just wondering how you're thinking about modeling that. And Ida must be thinking about this for Norway. You guys are trying to go green, but at some point there is going to be a tipping point. And I just wonder what where that comes into your calculations.
Thank you.
Yeah, my question is in a certain sense a direct follow-up and comes back to this key question for monetary policy, whether the shocks are temporary or permanent. And my question would be to Jill to ask, is there any indication that the oil price and maybe the gas price is a random walk? So most shocks are permanent. Or do you see evidence of some equilibrium price towards which the daily price tends to return after a shock? Maybe an equilibrium price which varies over time, but nevertheless something which would imply that most shocks are transitory.
Yeah. To Lucrezia, please.
Yes, thank you. I have one question for the central bankers and one observation. The question is that there is work on the optimal inflation targeting that relates the trend in relative prices to the optimal inflation target, so that you want to minimize distortion, and then when there are trends in relative prices, you want to have a higher average inflation level for that reason. So it seems to me that that work would be relevant to think about the future, level of inflation target. If you think, the long term, I'm not saying that you have to change it now, but thinking of the type of shocks that you are discussing. So the question is, are you thinking about that? Is there any analysis in-house? And the observation is that actually the weather forecast has become much, much better. So that's unlike economic forecast. So that's good news.
Joachim, please.
Joachim Nagel, Deutsche Bundesbank. Regarding the perception of the energy market, I believe that central banks are definitely not in the driver's seat when it comes to energy market. I think we are used to the volatility of the energy market since 50 years, more or less, so we have to deal with the fallout. We are pretty good in this. This is my understanding here. But what is obvious, that the energy market is very opaque, it's not transparent, and it asks for much more regulation. And as I said, we are not in the driver's seat, so we have to ask who is in the driver's seat. And I believe that politics is here in the driver's seat. It is a little bit the same compared to the fragmentation when we're talking about the capital market union. At least I can say it for the European Union. I think the energy market is even worse. So we have to discuss this fragmentation, and we have really to get better here. And this is one of the major challenges I see here. But as I said, central banks, we can ask for that, let me say, homogeneity and reduce the, let me say, heterogeneous situation. But I think the task is on the political, it's in the political arena. Thank you.
Thank you. So we have a final round of responses, wherever you, whoever you would like to respond to.
On the final comment on regulation, as I said, I think that the first step to me is oversight and increased transparency. We cannot regulate what we don't know how it works, so we need to get better data. And I think that what it was concerning to me, looking at the reaction of policymakers in 2022 in particular, was that at some point they were blind. They didn't know what was happening, and they didn't know what they were missing. And I think that improving that transparency and getting more information of the sector, it will be a very good first step. And then we can decide that we're actually, when we have that information, whether we need the regulation or not. But I think that the first step is increase the transparency.
Sure. Christiane?
Yeah, I guess I'm going to speak a little bit, which is actually outside my usual field, but I have some views on the energy transition and kind of like speaking to Anil's question to some extent, but also following up on what Miguel said. So I'm less optimistic relative to Miguel about how fast we're going to accomplish that. And I think one important thing that has not been mentioned yet is that we need to take into account the purpose for which we use fossil fuels, right? So you mentioned heat pumps, for example, but I'm thinking, yet coming from the oil angle, more of transportation, where there start to be kind of like substitutes with electric vehicles and stuff, but to scale that up basically is going to be, in my view, a much longer term process. And so the tipping point that you mentioned, Anil, I think is still, in my view, far off. So kind of like and that's why, in a way, the oil-producing nations still gonna try and take advantage of it, but they're facing their own structural issues, as I mentioned, right? So kind of like this years of underinvestment, and they have to make the difficult decision in the end, is it worth it? And kind of like, what is the planning horizon, right? So, I guess they have to find a balance there and make their cost-benefit analysis and yeah, decide based on that.
Miguel.
Yes, thank you. So first on the point that Javier was mentioning, I think definitely it's super important to have standardized monitoring and supervision of trading houses. I think, you know, at some point, as Javier was mentioning, there was a certain blindness in the policy making because it was not clear who was trading what, under which conditions, you know, at what price, which volumes. I mean, getting this information up to date was not possible. And it's not possible because we have different regulatory regimes, you know, nationally, but also at the European level. And the question on the tipping point, I think there, as I said before, we might not be able ourselves to influence a lot supply of fossil fuels. What we can is influence demand, because in Europe we are importers of commodities. So I think providing this certainty to those producers that sell their fossil fuels to us is extremely important. Thank you.
Thank you for the question. The literature on optimal inflation targets is indeed an interesting one. I think now, for the time being, for most central banks, and Norges Bank is no exception, our sole focus is on getting inflation back to target. But it has it adds to the trade-offs that we might be facing going forward in the face of cost push shocks and in the face of supply shocks in energy markets, that we do need to be sufficiently forward-looking so as to allow those relative price changes, including those from carbon pricing, to feed through. So I think it's an interesting debate, but for now I think we are focused on our main objective of getting inflation back to target.
So thank you very much. I think we have to come to a close. Everybody's hungry now. Let me just say a few words what I am taking away from this session. I think what's also shown by Christiane, that it seems that the supply of fossil fuels is becoming less elastic, which also leads to this higher elasticity, the higher volatility in fossil fuel prices. The panel is of the view that we are going to face more frequent and more persistent energy price shocks due to the mismatch between supply and demand, due to what's happening at OPEC, due to the weather. So this is, of course, creating challenges for us. I think I agree with Joachim that I mean, we have to deal with it, but we cannot solve the problems. And so this is clearly up to governments. I think you convinced us that the commodity traders need more oversight after we've learned what they're actually doing, and you've already told us a bit of that. We certainly need infrastructure massively. I mean, we need grids. We need the expansion of renewable energy.
I mean, on the analysis side, we need to integrate the energy sector into our models, and of course, we are already doing some of that. And so there's a lot to do, a lot to learn, many challenges. Thank you very much for sharing your insights. It was a very interesting discussion. I enjoyed it enormously. I hope the rest of you too. I wish you all a very nice rest of the day, also with some social activities, which is new at Sintra. But I'm going to hand over to Claire now.
Thank you very much, Isabel. So that brings to a close the formal proceedings for today's events. I'd like to thank President Lagarde, all of our panelists and our chairs for a great start to the event, and with plenty of compelling insights into the not so steady state we're in. There's some mixed feelings, I think, about whether or not Godot will show up, but if he does anytime soon, I think it's going to be in pay packets or shopping baskets rather than riding in on an oil tanker. So please join us again here in the room tomorrow or online at 9 a.m. We'll also be finding